Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello friends, welcome to this revision session on interest rate risk management chapter. Now this is a fairly important chapter as far as CA final AFM is concerned. You typically get anywhere between 5 to 12 marks actually, and sometimes you get a 12 mark question, sometimes an 8 mark question, and most often than not you get anywhere between 5 to 8 marks a question for sure. So let us move to this particular chapter. Now one thing I want to highlight is this is a summary notes or a concept notes or last day revision notes, what I want to call it. This is available as a link in the description of this video, and you can access it directly, and I will, as time goes by, I will also keep updating it wherever required. So you can access this. Now let us dive right into the topic. What is interest rate risk management? What are we trying to achieve in interest rate risk management? I will be covering some elements of theory because there are good theory questions also. So please be alert, because in exams they will ask you theory stuff also. Interest rate risk basically is the probability that a change in interest rates will affect the value of a bond or a fixed rate investment. So here we are talking about a bond or any other kind of fixed rate investment whose value will change because of change in interest rates. If you remember in the security evaluation bonds chapter, as interest rates go down, prices go up, and as interest rates go up, prices come down. Same logic. We are trying to ensure that the change in the price of a bond or changes in the value of a loan due to changes in interest rate do not affect the party who is either a borrower or a lender or whoever the case may be. That is what is basically all about interest rate risk management. Now, what are the factors that affect interest rates? There are three factors: demand and supply of money, inflation, and government operations. What is this government operations? Government of India, or rather RBI, through its open market operations, buys and sells government bonds. RBI is basically the manager of the government of India. So whenever they see liquidity position, right, wherever they see that there is a lot of liquidity or there is excess liquidity or shortage of liquidity, they pump in money or withdraw money. Whenever money is available, then interest rates typically soften. Whereas when money is very, very tight, that is liquidity is very, very tight, interest rate is high. So when liquidity is high, it means that there is a lot of demand, there is not enough money for the demand. So when there is a high demand and very, very low supply, the interest rates are high. On the contrary, when there is low demand and supply is adequate, then interest rates are low. So in a loose monetary policy, that is when RBI ensures that there is enough money supply, then interest rates are low. Whereas when RBI tightens the policy, that is they keep on selling the bonds and withdrawing the money from the market, the interest rates rise. And then there is this whole thing about inflation. Inflation and interest rates are very, very closely linked. Typically when inflation rates are very, very high, then RBI tends to increase the rates, and when inflation rate is fairly low, the rates are also fairly low. Initially, when the rates are very, very high, inflation comes under control, right? But then RBI reduces the rates, but then again inflation goes up, so RBI increases the rate. So it's actually a sort of both of them operating together. There is no one specific thing that A directs B or B directs A. It's a combined environment in which both of them are very, very closely linked with each other. Now, how do you measure? What are the types of interest rate risk and how do you measure? So what are the various types of interest rate risks? You have this gap exposure, basis risk, embedded option risk, yield curve risk, price risk, and reinvestment risk. What is this gap exposure? Gap exposure basically refers to difference between a bank's rate sensitive assets and liabilities. What are rate sensitive assets and liabilities? Assets and liabilities whose values are affected by change in rates. So if you have assets which whose value increases or decreases because of there is a change in rate, or liabilities whose values increase or decrease because of there is a change in rate, then there is a gap between assets and liabilities. The gap between rate sensitive assets and the gap between rate sensitive liabilities is known as gap exposure. Now we will learn more about gap exposure. A positive gap is one where rate sensitive assets are greater than rate sensitive liabilities. So in exam, if you are asked this question about gap analysis, you have to use this specific terminology. That is, what is positive gap and what is negative gap. Positive gap is one where rate sensitive assets are greater than rate sensitive liabilities. That is, an increase in the interest rates. If the interest rates increase, what will happen? The value of bonds comes down, will lead to an increase in net interest income. That is, your portfolio of assets and liabilities is such that when there is an increase in the interest rate, you are actually getting more interest income. right? That case you have a positive gap, whereas a decrease in interest rates, that is, when you have a negative gap, a decrease in interest rates will lead to increase in net interest income. So, a positive gap is one when assets are greater than liabilities, and in positive gap, an increase in interest rate will lead to an increase in net interest income. Negative gap is one where rate sensitive assets are lower than rate sensitive liabilities, and a decrease in interest rate will lead to an increase in net interest income. What is this net interest income? In both the cases, we are talking about increase only. Increase of net interest income due to an increase in rates is when you have a positive gap. Due to decrease in rates is when you have a negative gap exposure. And positive gap exposure is RSA is greater than RSL. Negative gap is RSL is greater than RSA, or RSA is less than RSL, whichever way you want to see this. Now, some of you might get it out. What is this net interest income? Net interest income is nothing but for a bank or for any kind of a finance lending business that is, that is there, the interest income which they earn from all their assets minus interest expenditure which they incur on their liabilities. The gap between these two is called net interest income. Interest income, always banks earn, what are banks' assets? Banks' assets are the loans that they give to people like you and me. On those loans, they earn income. And what are banks' liabilities? The deposits that we put into bank are their liabilities. So on those deposits, they pay out interest. So if you always notice, housing loan interest is 10%, but our FD interest is only 5%. That 5% gap between their income that they get versus the expenditure that they incur, that is basically what goes into the net interest income. That 5% is not net interest income, it is at the gross level. You combine that for all kinds of loans, all kinds of deposit, everything, and look at it on a weighted average basis and subtract some basic costs from that, you get a number called NII. It is not there in our syllabus. I am just explaining so that you understand what is NII. Don't randomly write or vomit in the exam hall saying that there is something NII without even understanding what it is. Okay, so I always think that you should remember certain concepts. You should know certain concepts like this. Now, how do you evaluate this gap exposure, the risk due to gap exposure? Basically, what is this gap analysis and what does it tell finally? I mean, it tells you how NII is sensitive, but then you evaluate the sensitivity by using one particular method called EAR. EAR is earnings at risk. It is the amount of change in NII due to change in interest rates. That is, if there is a change in interest rates, how much is your NII changing? Gap into probable change. That is, gap into probable change in interest rates is equal to impact on interest rate change on earnings. Whatever is the gap into probable change in interest rates will give you the impact of interest rate change on your earnings. So this is called a earnings at risk approach. Right? This is how you measure the sensitivity of your net interest income due to change in interest rates. Now, what are the other ways in which, what are the other interest rate risks that you have? You have something called as basis risk. What is this basis risk? It is a risk that interest rate of different assets, liabilities and off-balance sheet items may change in different magnitude. That is, because there is a 1% increase in rate, your assets may go up by 2%, your liabilities may go down by 3%, your off-balance sheet items may completely go for a toss. We don't know what can happen, but each one has a very different impact. Why can there be a different impact? Of course, you have studied in the fixed income chapter that short duration bonds have lower sensitivity, high duration bonds have higher sensitivity, obviously, right? So such kind of things will have different impacts on different kinds of assets and liabilities. So you are in basis risk, you are evaluating or you are checking, or rather in basis risk is one where the change in interest rate has different magnitude impact on different assets and liabilities. Then you have something called as embedded option risk. What is embedded option risk? All of you should know this. Risks such as call, prepay or delay in repayment or default in interest and principal payments due to change in interest rates. What is this logic? So if you recollect, we have this convexity, and if you remember in the full class also I explained something called as negative convexity. If you're not taken my class, no problem. It is a very simple concept. So the call, if there is a bond on which there is a call, what is a call? The company has a right to call back the bond and repay the money. When will the company call back the bond? When the company believes they can refinance the same bond at a lower interest rate. That means rates have fallen down. Okay, your current bond rate is 7%, but market interest rate for same bond is 1%. So when the interest rates go down, what happened? The price of a bond increases. So price of the bond has moved from 100 to 150, but the company is able to refinance the same loan at 1%. So what company will do? I will call back the bond at 100 rupees or 105 rupees, something. Instead of paying you 150, I will call it back at 100 or 105, and I will issue fresh bonds at 1%. So I am making that 7% minus 1% interest saving. So such kind of things happen when there is a call option attached. Same way, think of a home loan. When interest rates go down, a lot of people refinance the home loans. If think of a home loan, fixed interest rate home loan, right? So you borrowed at 10%. Interest rate in the market now is only 2%. What will you do? You will say, Baba, I will repay your loan by borrowing fresh loan. That is what happens. And why can you repay the loan? Typically, banks allow you to repay. That is, you have an option to repay. Please note the words. You have an option to prepay or repay. When such kind of options exist, there is a risk that the loans may be repaid earlier, the bonds may be called back, things like that. So all these things are reflective of the embedded option risk. And you may also have default in interest and payments. If the interest rate goes up, you borrowed a home loan at 8%, now interest rate, let us say, is 25%. All your EMI is going only towards servicing the interest. It is not sufficient to service the principal. What will you do? There is going to be a default. So such kind of risks exist when there are embedded options. Yield curve risk. What is yield curve risk? That is the risk of change in bond prices due to changes in yield curve. So if you recollect what we discussed in the security valuation bonds topic, the yield curve basically plots for different kinds of tenures. What are the yields? Now, if there are changes in the yield curve which affect the prices of bonds differently than what you anticipate, right? Typically, what we think that there is this is the yield curve. Typically, a lot of people assume that there are shifts in yield curve are parallel. They are not parallel. Yield curve shifts are more like this. Okay, so when such kind of things happen, bond prices go for a toss. So that is another risk. Then you have price risk. What is price risk? This is very, very simple. Risk that the value of a security or investment will decrease when assets are sold before their maturity. So let's say you are a bond investor and rates have gone up, the bonds have come down substantially. When rates go up, bond prices come down. So you may probably sell off your bond at a loss. So such kind of issues may happen when interest rates go up. So that is called price risk. The price may change and it may change unfavorably. Then you have reinvestment risk. What is reinvestment risk? The risk that uncertainty on interest rate at which the future cash flows can be reinvested, high for bonds with high maturity and coupon. So let's assume I have a 30-year-old bond and I have invested, or when the bond was issued, interest rate was 5%. Now, let's say interest rate has dropped to 1%. What will happen? When interest rates fall, the price increases. Correct? So the bond which was issued at 100 probably is now trading at 150. I am putting random numbers. Okay. But what is the interest that you are getting on this bond? On 100 you are getting 5%, so you get 5 rupees. This 5 rupees you are not able to invest back in the market at 5%. You can invest in the market only at 1%. So there is a very high risk that whatever inflows that you are getting due from a bond, whether in form of coupon or let's say the bond is repaid or whatever, you are not able to reinvest it the same rate at which you originally invested. So this is called reinvestment risk. This is called reinvestment risk. So these are the broad risks that we have in interest, broad kinds of interest rate risk. Now let us move to the next aspect. What are limitations of gap? The issue with gap is it considers only the time difference between repricing dates of assets and liabilities. It fails to measure the impact of basis risk and embedded option risk. So if you look at gap analysis, what is gap analysis? Rate sensitive assets minus rate sensitive liabilities, the difference. Now, does it consider even option aspects into it? Does it consider even basis risk aspect? What is basis risk? Basis risk is that there is a different, the magnitude of change on assets and liabilities is different. That is basis risk. Now, does your gap analysis consider the basis risk? Gap analysis only says, there is a change in net interest income. It only measures that change in net interest income. It is not trying to analyze whether the change is due to any embedded option or due to basis risk. All those aspects are not considered. It is only the time difference between repricing dates of assets and liabilities. Then assumes all are matured or repriced simultaneously. It assumes that moment there is a change in interest rate, everything happens parallelly. See, it may or may not happen. In real world, some kind of assets and some kind of liabilities, the repricing may be different. You may have different interest reset date. How do you know? So all those aspects are also not taken into consideration. Then ignores differences in timings of payment consequent to change in interest rates. So Gap analysis does not consider differences in timings of payments. What does it mean by timings of payments? Assets you may have on assets, you may get inflows on 1st of January. Outflows, you may have payments on 15th of January. Are these both the timing differences considered? No. It is only looking at value of the asset and liability which is increased or decreased. That too assuming the value changes automatically whenever there is an interest rate change. Assumes a parallel shift in yield curve, not practical, which is exactly what I was telling you. All of us, when we think of interest rates, no, this is time, this is yield, this is a yield curve. Let's say this is yield curve 1. When we say interest rates have gone up by 1%, we automatically presume everywhere 1 is what we assume. That doesn't happen. What typically happens is, when you have something 1%, probably one rate has gone up by 1, other rate has gone up by only 0.5, other rate is stable. So in fact, it may be like this, and some have gone down also. So we don't know. So we cannot assume that all tenure interest rates change in the same proportion. Okay. Then doesn't consider impact of interest rate changes on non-interest based revenue or expenses, that is upfront fee and LC commission. So you have to remember this, that is, when interest rates are very, very low, I may probably be open to opening more LCs. So when I open an LC, bank gets LC commission. When interest rates are very high, if I have money, I will probably not borrow and rather repay the loan. So at that point of time, I may not open an LC, or I may not do any international buyer's credit transaction, seller's credit transaction, or anything where bank earns non-interest based revenue. Okay. So such kind of things also get affected when there are interest rate changes. That is not captured in a gap analysis. So these are broadly the limitations of gap. Okay. Then how do you measure the interest rate risk? So what we learnt earlier, all those 6 methods, those are types of risk. How do you measure them? Maturity gap analysis, duration, simulation and VAR. These are the 4 methods in which you measure interest rate risk. First one, what is maturity gap? Measures the interest rate sensitivity of earnings, what we discussed. If there is a change in interest rate, how much it impacts the earnings. So this is the first one. Then duration, it measures the sensitivity, interest rate sensitivity of capital. Same duration concept, what we learned in security valuation bonds. Okay, that is used to measure what is the change in the value of the bond, right? Then simulation, ALM simulations of the term structure of interest rate. Asset liability management, ALM refers to asset liability management. We are going to learn about it in a few minutes. So you simulate changes in various interest rates across various tenors and then see what is happening to your assets and liabilities over a period of time, right? So if the interest rates change in different manner for different periods, then what is the impact on assets and liabilities that you measure? Then VAR, it measures the risk of loss for investment. Same VAR concept what you learned in risk management chapter, initial chapters what you learned, same thing. You use VAR also to measure the interest rate risk. How do banks manage this entire interest rate risk? They have 2 books. One is called prop book or trading book, other one is called investment book or banking book. Prop book is focusing on generating short-term returns. Basically, it's a trading book, morning buy, evening sell, something like that. Short-term differences in prices and yields, that is the focus. Focus on generating profits on short-term price changes. Investment book is long-term. It comprises of assets and liabilities contracted for steady income and statutory obligations, generally hold to maturity. So, banks have given a 30-year loan. That is not your trading book, that is an investment book. Bank has borrowed 30-year-old bond by issuing a 30-year-old bond. That is also again investment book, right? So statutory assets and liabilities and business, long-term business, those both together form the investment book. Now, the way they manage interest rate risk is different for these two. That is why we are first explaining these two. How do they manage for prop book or trading book? Main concern is price risk. Will there be any change in price? I bought in the morning, I am selling in the evening. Am I selling it at a lower price compared to morning? That is the first thing that they are bothered about. Whereas when it comes to assets and liabilities, they are more bothered about what is the change in economic value. Is the change in economic value temporary, permanent? What is the impact of all of this on earnings? So that is what is the main concern. So they bifurcate their problem into 2 parts: short term, long term. Short term they look at day-to-day price changes. Long term they look at change in economic value. That is how they manage the risk. Now let us move to the next aspect. So now we come to the main important part of this chapter. What are fixed rates and floating rates? Fixed rate means same interest rate for entire tenure or term of the loan, that is a fixed rate. Floating rate means interest rate that is variable or changes during the loan tenure. Example something like BPLR, MCLR, MIBOR. What are all this? We will understand all of them as we move forward. But if you recollect, whenever we were looking at bonds, we always assumed that the interest rate of the bond is fixed. 8% bond, 7% bond, 10% bond. Those are all fixed rate bonds. Do you have variable bonds? Yes, you have variable rate bonds also. In fact, most of the housing loans are linked to a variable benchmark rate. That benchmark rate is called BPLR or MCLR, prime lending rate, or marginal lending rate, or MIBOR. MIBOR is Mumbai Interbank Offer Rate. So you have varieties of such benchmarks. These are mostly Indian benchmarks. You have varieties of other foreign benchmarks also. Let us go and understand what are these benchmarks first. What are benchmark rates? These rates form basis for determination of other interest rates. That is, they are the benchmark. Other interest rates are linked to these benchmarks, also known as reference rate. They are also known as benchmark rates are known as reference rates. They are very important for an economy banking system for all transactions, because most of the transactions actually are linked to variable rates than fixed rates. They form the basis of contracts such as bank ODs, loans, mortgages, complex financial transactions. So for a lot of them, you have variable rates, which basically are these benchmark rates. These are used in derivative transactions also, such as forward, futures, options, and swap. They also use these rates. The forms basis for floating rate loans. This is exactly what I was telling. So most of the floating rate loans are linked to this benchmark. Like my home loan is linked to, let's say, repo rate. Repo rate plus 6% spread. Okay, there are home loans that are linked to repo rates, by the way. Then, generally, based on relative credit rating, spread in basis points is added over the benchmark rate for loan or bond issuance. So, I am a bad person in terms of credit score. So, my loan rate is repo plus 7%. Suraj, the FR faculty co-founder who teaches FR, right? He has better credit score. So, he gets it at repo plus 5%. It is possible. Banks are allowed to lend like that. Right. So, home loans and several other loans, even corporate loans are linked like this. So, AAA borrowing, you will have a lower spread. BB borrowing borrower may have a higher spread. How are these rates decided? They are decided by an independent body after considering various factors. In financial transactions, both domestic as well as international, benchmark rates are used. So, domestic we have domestic benchmark, foreign we have foreign benchmark. What are these? We will understand. Most popular benchmark, LIBOR. This used to be a rate, there used to be a rate called LIBOR. Even though it exists in some part, a lot of questions of CA Institute are linked to that LIBOR rate. Unfortunately, after manipulations in 2012, it was decided in 17 that LIBOR would cease to exist. So, LIBOR, old loans are continuing, but no new loans are being given. And from 1st January, companies are required to use an alternative reference rate called ARR. So, companies, banks, everyone are required to use ARR. They are no longer, LIBOR is no longer valid. These ARRs are different from LIBOR. So, ARRs are different from LIBOR. I will help you understand what it is. They are based on actual overnight transactions, either secured or unsecured. LIBOR is unsecured without collateral, relies on judgment of panel banks. So, what used to happen with LIBOR is, there used to be 5 or 6 banks in London, RBS, HSBC, Stan Chart, Citi. The rate at which they both would lend to each other in London for a specific currency, for a specific tenure. A 3-month borrowing between RBS and Stan Chart, okay, is in London is at what rate? In dollar denomination is, let's say, is 1%. So, that rate would become the benchmark on that day for 3-month LIBOR. So, you used to have 3-month LIBOR, 6-month LIBOR, 1-year LIBOR, then you will have monthly LIBOR, then you will have LIBORs based on USD, largely USD only, and you also had on some other currencies. So, such kind of a rate was actually taken by, such kind of a LIBOR that was announced was taken by taking an average of all the rates of all the London banks. And all these London bank people got they used to manipulate. So, if on that day, if they wanted some more income, they all would quote each other a high rate. That's how they used to manipulate. So, if they know that, Tatas are going to issue a loan today, okay, or go for a borrowing, issue a bond today and are going to make a borrowing. So, all these banks said, "Arey, today Tata is coming with a $1 billion loan, let us raise the LIBOR rate to 2%. Suddenly, rate will go up 2%, but Tata will have to pay 2%. What is this 2%? Here I told you, repo plus 7%. If repo is 2%, I pay interest rate of 9%. Same way, if Tata is going to pay, LIBOR is 2%, Tata will have to pay 2% plus spread of 100 basis points or 200 basis points, whatever is the negotiation between the lender and the borrower. So, they would jack up the rates like this, and I've just given an example of Tata and RBS and all that. Actually, people who were involved in are different. RBS was involved, but I'm just giving you an example. Don't take this literally, in literal sense, right? So, this LIBOR was without any collateral between banks, unsecured, and relies on the judgment of panel banks. So, panel banks could decide what is the rate, whereas ARR is based on actual transactions. Only if there is a transaction happening between a bank, it would have that rate would be considered. They are near risk free with no term premium. So ARRs are near risk free because they are between banks. ARRs have different names, regulatory in nature. So different countries have different ARRs. They are based on geographical locations and currencies. What are these? Let us see. In USA, you have something called as SOFR, SOFR, which is Secured Overnight Financing Rate. It is a secured loan. It is, the announced or rather handled, the regulator who handles it is Federal Reserve Bank of New York. So in USA, you have multiple reserves. In India, we have only one Reserve Bank of India. In USA, you have every state as a Reserve Bank and then there is a Federal Reserve. Here they are referring to Federal Reserve of New York. UK, there is a rate called SONIA. Nice name, no? Sterling Overnight Index Rate. It is unsecured and the regulator is Bank of England. In Europe, you have ESTER, ESTER, ECB is the one who regulates. Again, it's also unsecured. Japan, unsecured, TONAR, TONAR, Tokyo Overnight Average Rate, Bank of Japan. Switzerland is SARON, Swiss Average Rate Overnight Secured. SARON, Lord of the Rings, I don't know if you know SARON. SIX6, Swiss Stock Exchange is the one who handles it. Then India, you have MIBOR and MIBID, Mumbai Interbank Offered and Bid Rate, and the regulator is RBI. So these are the rates at which transactions have actually happened between banks, and those rates are considered and some kind of an average is taken or something like that to figure out what is the rate applicable for borrowings today. What is the benchmark rate applicable for borrowing? So benchmark plus spread, that is how loans are. So if today I am borrowing, if today I am Tata and I am going to borrow and my borrowing rate is going to be fixed as variable. How will variable be fixed? They will say benchmark plus spread of 2%. What is the benchmark? Benchmark is today's MIBOR, let us say, is 5%. So 5% plus 2% is equal to 7%. So the borrowing rate is 7%. Okay, so that is how benchmark rates are used. This is a new thing and I genuinely think there is a question, good possibility that a question can come from this. Then, how do you manage risk, interest rate risk? There are two approaches, traditional and modern. Everywhere in most of the chapters that we have studied right from portfolio management onwards, traditional, modern, traditional, modern. Let us see. Traditional approach is you have ALM and FRAs. These are very traditional approach. Modern approaches are interest rates, bonds or futures, interest rate swaps, interest rate options and swaptions. Okay, we'll go through each of them. We'll come back to that. But first, let us understand the first aspect, which is asset liability management. What is asset liability management? It is an important tool of risk management for commercial banks in India. It is generally, RBI prefers this method for banks to manage their risk. Asset inflows are scheduled in such a way that they match liability cash outflows. So you are basically matching the inflow and outflows of various assets and liabilities so that you never run out of assets to meet your liabilities. That is the whole idea of an ALM system. Objective is to never run short of money to meet liabilities and not have surplus money without earning return. So you cannot have surplus money that is lying idle. Banks need to implement strong ALM mechanism to ensure its customer deposit can be paid back at any time, at any given time. Okay, ALM addresses risks, that is interest, currency, inflation, financial, market resulting from mismatch of assets and liabilities. So the financial risk is considered, the interest rate risk is considered, currency risk is considered. All this have to be combined. They have to reflect in the value of assets and their asset cash flows, cash inflows basically. They have to reflect in the value of all liabilities, cash outflows basically. Both these asset cash flows should be greater than liability cash flows, and assets should not have too much surplus. If there is surplus, that should be invested. So that is how an asset ALM mechanism works. Then the risk management team under ALM evaluates the impact of business decisions on assets and liabilities and feeds inputs into bank's business making decision. So whenever bank does large borrowings or they make large they get large deposits or they give out large loans, they have to ensure that the ALM mismatch does not exist. Alright, so this is the first approach, which is asset liability management. If there is a question that is asked, you have to respond for this. This is also an important question. Then FRA, forward rate agreement. This is where the real fun starts. Forward rate agreement. What is a forward rate agreement? It's an agreement entered today. Today I am entering into it, to borrow specified amount at a future date. So it is, let's take a forward contract, but on forward contract I am agreeing to buy or sell something. Here I am agreeing to borrow something for a specific interest rate and a specific tenure. Okay, if you are long FRA, you are borrowing. If you are short FRA, you are lending. Same way, if you are long forward, you are buying something. You are short forward, you are selling something. Same logic. The underlying in this contract is interest. So here the underlying, I am borrowing a specific amount of money for a specific interest rate. Here it is not just about the amount that is being borrowed, but the interest rate. The underlying is the interest rate. These are OTC, they are not market traded, they are cash settled. Usually actual borrowing does not happen. Settlement amount is arrived at on the fixing date, there is a borrowing date. So I am agreeing to borrow. So, in fact, I think example is better way to understand this. Let's say beginning of month 1 on day 0, I am entering into a contract saying that I will borrow 1 million 1 into 4 FRA at 5%. 1 into 4 here means I will borrow after 1 month and the borrowing will end after 4 months. So, when does the borrowing start? After 1 month from today. When does the borrowing end? After 4 months from today. So, it is a 3-month borrowing after 1 month. That is basically logic. After 1 month, borrowing after 1 month and for a period of 3 months. Okay. So, this is basically what is an FRA. Now, what are we saying here? Settlement amount is arrived on fixing date. What is this fixing date? So, at the end of month 1, on this day when you have agreed to borrow, that day is called as a fixing day. Why is it called a fixing day? Because you are agreeing to borrow at a fixed rate on this day. But on that date, when you are agreeing to borrow, you are agreeing to borrow on day 0. You are going to borrow on this month 1, or you call it day 30, because 1 month is 30 days, right? Assume 30 days, month 30, on day 30. You are agreeing to make a 3-month borrowing after 1 month today at, let's say, 5%. Rate is fixed. But come the day 30, market mein 3-month borrowing is at 10%. Or you are a super smart person. You have agreed to borrow at fixed rate of 5% when on that day market rates for 3-month borrowing is at 10%. Now again, please note all the interest rates are in per annum basis only. The per annum interest rate for a 3-month borrowing is 10% per annum. That's the logic. Okay. So, interest rate has gone up. You are a super smart person. You are a very wise person. You have been able to ensure that your borrowing is at 5% and not at 10%. So, the day when the interest rate is fixed for the borrowing that you are potentially going to make as per an FRA, that is on day 30, that day is called as the fixing date. So, on fixing date, you are going to make a borrowing at 5% when market is at 10%. So, you are saved basically 5%. So, let us read further. Settlement amount is arrived on fixing date, that is borrowing date. Present value of settlement amount changes. And what is this present value of settlement amount? First, let's see what is settlement. Settlement amount is difference between contract rate and reference rate. So, you have agreed to borrow at 5% versus market rate is 10. So, you have made a gain of 5. So, 5% into, what is the rate here? 5%. Let us say instead of 10%, it is 6, because I have given an example for 6, that is why I am taking 6. So, you have made a gain of 1 percentage point. So, 1 million, which is what you agreed to borrow, into 1%, which is 6 minus 5, which is the gain that you are making, into 90 by 365. I have a round figure taken that each month has 30 days. So, for 3 months, you are going to save 1% on 1 million, which comes to some number. But that interest, whatever interest saving is there, when is the actual interest saving? On the day you borrow or on the day you repay borrowing? Please remember, most of the cases you have something called as when you have the short term borrowings, interest is repaid on the last day, or you repay it on monthly rest, or you have some kind of interest rest. But the interest is not paid on the fixing date, or the day you borrow you don't pay interest. But here the difference of 6 and 5 is computed on the fixing date. So, that 1% interest, assuming that the repayment is made after 3 months, and when the repayment is made, interest is also repaid after 3 months. The present value of that 1% that you are going to gain, which is 1% plus 6% into 90 by 365. Why am I doing 90 by 365? This is the present value factor. So, I have computed the saving for a 3-month period, dividing it by the present interest rate for 6%. Why 6%? 6% is today's rate. So, you have to divide it by 6% only. You cannot divide it by 5%. Why? 6% is the market rate. So, divided by 6% adjusted for the 3-month period, you arrive at a settlement value. So, this is settlement value is present value of interest saving discounted at the reference rate for the specific time period of the borrowing. So, present value of interest gain discounted at present value discounted at the reference rate of 6% adjusted for time period of the borrowing. That is how you arrive at $2,400. So, settlement amount is difference between contract rate and reference rate, that is floating rate. Reference rate is floating rate. Typically, why is reference rate changing? Because after 1 month, the rate for borrowing in the market is 6%. How can the market rate be 6%? Because market rates continuously keep changing. That is why market rates are floating rates, whereas you agree to borrow at a fixed rate of 5%. Please remember that, right? And present value changes hands. So, because I am a smart person, I earned money. That 1% discounted for 3 months is given to me, $2,400. It is used by banks to fix interest costs on anticipated loans, on anticipated deposits, or interest revenues on variable rate loans indexed to benchmark. So I will fix my interest cost on future deposits. It's an off-balance sheet instrument. Off-balance sheet means just a contract. There is no accounting entry for this. When it is entered, when a settlement happens, accounting entry is there. It is on notional value. That is, it doesn't involve any actual exchange of the principal. That is, it is cash settlement. There is no actual exchange of principal. I don't actually borrow. You don't actually lend. There is just directly a net cash settlement for the interest gain present value. Okay. And you see, borrower is a fixed rate payer. Correct. I agree to borrow at 5% after 1 month for a period of 3 months. I am agreeing, I am a fixed rate payer and floating rate receiver. But I am getting 6%. But what is that 6%? That 1% what I am getting is difference between 5 and 6. So basically, I am getting 6, paying 5, which is why I am getting 1. That is how you should look at this. And lender is a floating rate payer. Why? I entered this transaction with a bank. Banker is going to pay 6% and receive 5%, so they have lost 1%. So you have to remember this concept. Borrower is a fixed rate payer and a floating rate receiver, and lender is a fixed rate receiver and a floating rate payer. Right? This is FRA. And FRA, the broad formula is notional value into reference rate minus fixed rate into DTM by days in a year, and 1 plus reference rate into DTM by days in a year. DTM means days till maturity. Okay. Notional principal, reference rate, agreed upon forward rate, days of loan, total number of days. Okay. Now please note, if reference rate is greater than FR, forward rate, if reference rate, that is 6% is greater than 5%, what we just saw, long FRA gains. If reference rate is lesser than FR, that is reference rate is 4% instead of 5% agreed to borrow, I am a bad decision maker. So I lose. Short FRA gains, that is the lender gains, so the borrower loses. Right. Now there is one more point in this what I wanted to highlight. This is when you talk of 1 into 4 FRA, this is basically referring to months. But when you talk of 2v3, it basically refers to years. So borrowing after 2 years for a period of 1 year so that the loan will end in 3 years. So this is called 2v3, this refers to years, and 1 into 4 refers to months. 1 into 4 refers to months. Okay, these are the two things that you should remember. Then, where else? We have now understood FRA. Let us go and see if we can solve a few problems on FRA, and then we will again come back to these topics, because see, this is a fairly interesting chapter, well asked in exams also. We have initially seen a bunch of theory. Now we are coming to problems. I explained to you the first concept of FRA, where problems can be asked. Now let us go and look at all the problems in this particular FRA topic, and then we will move to the other topics, understand them, and also solve that problem. If you recollect this, I had given a list of important questions. So question 4, 11 and 13, 4, 11, 13, 16, let us see out of these 4 which are FRA questions, 4, 11, 13, 16, 19. So let us look at the first question. This is the question on FRA. This is the FRA question. It's actually also a 2019 November 19 question. P Limited is contemplating to borrow 50 crores, period of 3 months in the coming 6 months, time from now. So it is what kind of an FRA is it? It is for 3 months after 6 months. So it is 6 into 9 FRA. The current rate of interest is 8% per annum, but it may go up in 6 months' time. The company wants to hedge itself against likely increase in interest rate. So they will go long on FRA, okay, at 8%. The company's bankers quoted an FRA of 8.3. Acha, they quoted already 8.3. So the bank also knows, they are also smart, that interest rates will go up. Compute the effect of FRA and actual rate of interest cost of the company. If the actual rate of interest during consideration period happens to be 8.6, acha, you enter into FRA for 8.3, but market rate is 8.6 or 7.8. What happens? So if it is 8.6, you made a gain. If you've gone long on FRA, you've gained 0.3%. If you've gone long on FRA at 8.3 and market rate is 7.8, you've lost 0.5%. See, P Limited will go long on a 6 into 9, 50 crore FRA at 8.3. This is the first statement you have to write in your solution. If you do not write this, you will lose marks. Please note. Okay. On fixing date, that is after 6 months, if interest rate is 8.6, then reference rate is greater than the forward rate. So P Limited will gain. Correct. Settlement value is N into RR minus FR. See, a lot of you might end up remembering the formula. If you write the formula, great. Even if you don't write the formula, but explain that, this is the reference rate, this is the fixed rate, and then directly fill up the formula, it is fine. See, the point is you have to understand the logic of the formula. Then you can replicate the formula on your own. Please don't mug up these formulas. You are in CA final. After this, you will be in a job. Nobody mugs up formula. Okay, everything is there, available on Google. Okay, you should remember the formula by logic and concept and not by its appearance. Substance is more important than form. Just like audit, it is important everywhere else in life. Okay, so notional value into whatever is your reference rate 8.6 minus 8.3 into DTM. Now they have said, have they given 90 days, 30 days, nothing. So when such kind of things are given, you can basically make an assumption. If they have not said the days in a year, they will have to specify what days you have to use, what kind of day convention, is it a month, day, year, what convention. If they have not specified anything, here you can directly take 3 by 12, 6 by 12, 2 by 12, whatever the number is, right. So here the loan is for 3 months. So what do? 50 CR into 8.6 minus 8.3, that is 0.3% into 3 by 12 divided by 1 plus 8.6 into 3 by 12. So you get 50 CR into 0.075% by 1.215%. So this 0.3, whatever is the difference, divided by 4, why 4? Because 3 by 12, why 3 by 12? Because the loan tenure is for 3 months after 6 months, right. So you get a value of rupees 3,67,107.20. Okay. The banker will pay this much towards FRA. Interest cost will be so and so. 50 CR into 8.6 into 3 by 12, which is the actual rate the company would incur. See, the company is borrowing at 8.6. The banker with whom they have entered into FRA is paid them 3 lakhs. So the actual interest that the company would pay will be 50 crores into 8.6 into 3 by 12, which is about 10 lakh 75,000. Sorry, 1 crore 7 lakh 50,000. But this is payable on maturity date, and it has received 3,67,000 on loan commencement date. Ignoring the future value of the amount received on settlement, then total cost of borrowing is, I am going to pay 1 crore 7 lakh 50,000. I am going to receive 3,67,000. Total value is 1 crore 3 lakh 82,000, and effective interest rate is 1 crore 3 lakh 82 into 50 into 12 by 3, which comes to 8.306. However, if you consider the future value of this particular amount, 3 lakh 67 into 1.0215. Why 1.0215? Because you have divided by 1.0215. So you are now multiplying with that, and then your interest cost will be same 8.3. I hope you have understood this. Either you take both interest receipt and payment on the same date, which is future value, or you take present value. You cannot take one present, one future and compute. So this 1 crore 7 lakh 50,000 is repaying date, whereas 3 lakh 60,000 is the fixing date. So the fixing date value also you have to move to the repayment date of the borrowing and then combine both and then compute the interest cost. You will get the same 8.3%. Now what will happen in the same logic if interest rate is 7.8%? 50 CR into 7.8 minus 8.3 into 3 by 12 by 1 plus 7.8 into 3 by 12. You get 6,25,000, which is the interest differential which you have lost. You divide it by 1.0195, you get 6,13,000. So they are allowed to pay 6,13,000 to the bank. And what is the effective interest rate? You have to again take future value, you will get the same 8.3. Why will you get 8.3? On the fresh loan that you are taking, see, this 6,13,000 is the loss on account of FRA. But you will now borrow in the market at 7.8. So you will pay 7.8%, but you have also paid this 6 lakhs extra. So this 6 lakhs, you compute the future value, and based on that, you add the future value of the 6 lakhs and at 7.8 on 50 CR, which comes to 97 lakhs. Both of them you take at the future value date and divide by the original loan that is taken, you will arrive at 8.3%. So basically, FRA ensures that your loan rate, borrowing rate is fixed at 8.3. It is fixed. The cash settlement happens, you have to add the cash settlement value to the loan that you will make, because the FRA is not a physical borrowing and lending of money. Okay, so this is the first question that we've solved, question number 4. I don't think the next question, what was the next question that we had? 11 and 13 and 16. I don't think 11 and 13 are FRA questions. I think they are different questions. Let us see. CAP. Okay, so this is a CFA material question. I've picked it out because I think it's a good question. It's on cap, interest rate cap. Let us understand what are these interest rate caps, and then we'll come back to this. Okay, please note students, if all this entire file whatever I am looking at, it is called P600 plus. If you are not aware, I know I am making you aware, this file in PDF form is available as part of the description on the video below. So please click on the description and then you can download this file. My theory notes, practical compiler, then formula sheet, then last day revision material, everything is available free of cost on my website for you to download. Okay, you can look at this video, all the links are given, you can click on them. Please subscribe to our channel, please share this video with your friends, whoever are preparing for the exams, and also please note that I have several other videos for similar topics like that I have put out on my YouTube channel. So for each chapter there is one revision video, please go and click that. That description, that details are also available in my YouTube channel. Okay, now let us look at question. Before we look at question 11, we have to understand certain topics and concepts. Let us go and understand those. So we have first finished the traditional approach. Now we are coming to the modern approach. What is there in the modern approach? You have interest rate futures, interest rate swaps, interest rate options, and swaptions. Okay, 4 ones. And interest rate swaps, again there are types: coupon only swap, principal swaps, or cross currency or circus swaps. Okay, then you have interest rate options or guarantees, which are interest rate cap, floor, collar. Then you have something called a special collar, special collar. Okay, anyway, so these are the varieties. So first we will look at this thing called interest rate guarantee or interest rate options. Then of course we will come to other aspects. So friends, now let us understand what exactly is an interest rate cap. Interest rate cap. Now there are two terms that you will understand when we are talking about interest rate options. So okay, interest rate options is or interest rate guarantee is the correct term, under which there are two kinds of options. One is called as a cap, other one is called as a floor. Okay, cap and floor, and then there is a combination of cap and floor which is called as a collar. First let us understand cap, then we'll go to floor, and then of course collar. Now a cap is one, or rather a cap contract is one in which you are restricting your interest outflow. It is just like an option on normal, your derivatives, whatever you see, stock options and all that, right? On stocks or currency, when you have an option, it's exactly like that. But the thing what happens in a cap is the borrower, and cap is entered into typically by borrowers. So I am a borrower who has borrowed some loan at 10%. Now the market rate at that particular point of time is 10. I have borrowed a floating rate loan. Okay, let us assume that the floating rate loan is some L plus 200, which works out to 10% today. Okay, basically LIBOR is 8. Okay, this loan, I am worried that LIBOR will go up and my cost of my loan will go up from 10% to let's say 15%, 20%, 25%, whatever. I am more worried that the interest rate will go up. So what I as a borrower will do is, I will enter into an option contract where I will restrict my interest cost to a certain number. Let us take example, I will take against LIBOR. LIBOR is currently 8. Against 8, I will say, I will enter into an option contract where if the LIBOR goes beyond 9%, goes beyond 9, okay, I am comfortable till 9, I will bear the risk, I will bear the interest cost. But if LIBOR crosses 9%, okay, let's say LIBOR is 10, then the other party, that is the party who is selling the cap option, I am the buyer of cap, there is a party seller of the cap. The seller of the cap, if let us say the LIBOR crosses from 9 to 10, up to 9 it is my headache, beyond 9 to 10 it moves, 1% the seller of the cap has to reimburse me. Okay, if LIBOR becomes 11, 2%, LIBOR becomes 12, 3%. So whatever is the difference between the market LIBOR rate and the strike rate or the agreed cap rate, right, that difference the seller of the option has to give to the buyer of the option, or seller of the cap has to give to the buyer of the cap. So I as a buyer, I am protecting myself from any increase in interest rates. Now this increase in interest rates, I am protecting myself. Why will I protect, or how will I protect rather? How will I protect myself against this increase in interest rate? Why will the writer or the seller of the option agree to reimburse me this 2%, 3% if it goes up? Because I am paying a premium. So there is an upfront premium that you pay. Okay, typically upfront only. Okay, because if you pay periodically, there is no meaning to it. Why? Because you will get to know what is the next period's interest rate by the time the premium installment is due. Okay, so typically you pay it upfront only based on today's conditions. You pay an upfront rate, upfront percentage of the total value of the loan. You pay some 1%, 0.5%, 2%, some number like that. And any time interest crosses threshold. In our case, I said the threshold is 9. Interest crosses 9, the seller of the cap will reimburse you the difference between the new number and 9. So up to 9 you are protected. Below 9 you are not protected. That is, interest rate falls below 8, below 7, below 6. You are anyway happy, no? You anyway wanted lower interest rates are falling down, LIBOR is falling, your floating rate you are paying lesser interest. So you need not pay more interest, so you are not bothered. Okay, there is no payoff if the interest rates falls below the strike rate or the cap rate. If interest rates goes above the cap rate or strike rate, then the seller or the writer has to pay you some money. So let us read what is there. If the market interest rate is greater than the cap rate, so in our case 10% is greater than 9%, buyer has a right to receive market interest rate minus cap rate, that is 10 minus 9, that is 1% into principal value. So notional principal. So you can enter into for a notional principal, that is even without having actually a borrowing. If you believe that the rates will go up, then you can enter into a cap. So that when rates go up, you get benefited by the increase in rates, wherein money comes into you on certain notional principal. If market rate is less than cap rate, buyer need not pay anything. That is, I will not pay anything to you, or seller also will not pay anything to me. Okay. Please note, when we say buyer need not pay anything, the logic here is, people should not misunderstand this. That is, when interest rate goes up, that party has to pay this party. When interest rate goes down, this party has to pay that party. No, nothing like that. The entire thing is only on one side. If the interest rate comes down from below 10, I need not pay the other party anything. I am okay because I am the buyer of the option, buyer of the cap. So I will need not make any outflow because of this particular interest rates coming down in respect to this particular cap. Cap is an option but not an obligation. So for a buyer, it is an option. Buyer pays premium to seller to purchase this option. That is what I told you. Cap rate is equal to strike rate or exercise price of the option. That is the rate at which the benefit or the gain or loss is computed. And if it is loss, there is no loss. But if it is a gain, you get the gain. Settlement amounts are determined the value of the benchmark rate on the interest reset date. So assume I borrow on 1120x1. Okay. So let's say interest payment is 6-month LIBOR plus 200 bips. Okay, I know I am still using LIBOR. I just now told you that LIBOR is no longer there, but that is how generally all of us are used to. Or you can take 6 months SONIA, 6 months SOFR, 6 months whatever the other number. Okay, other benchmark. Okay, so 6-month LIBOR plus 200 bips. Now, if it is a 6-month LIBOR, the underlying meaning is the interest is payable every 6 months. So interest service is 6 months. Loan is, let's say, 1 million. Now, on day 1, that is the day you borrow, let's say 6-month LIBOR is 2%. So at the end of one period, that is 11 to 36, for this period, on 36, you pay interest of 2, which is LIBOR, plus 2%, which is spread, which is 4% into 1 million into 1 by 2. By 1 by 2 because it is for 6-month period. So you pay 4% of 1 million, which comes to what, some $40,000. 40,000 by 2 is $20,000. This $20,000 you are due to pay after on the first, whenever the first interest is due. Now, when is the second interest due? Second interest payout due? Second interest is payout for the period 1/7 till 31/12. It is due on, let's say, 31/12 only. Okay, or we can take the next day, first 1/1 or something like that, doesn't matter. When is the interest due? This is due on 31/12. But what rate is it due at? The interest rate for this period is set when? On this date, 1/7. So on 1/7, whatever is the interest rate, so let's say on 1/7, 6-month LIBOR is 3%. So on 31/12, you are supposed to pay 3 plus 2, 2 is the spread, so you are supposed to pay 5%. 5% comes to again some $25,000. How? 5% into 1 million into 1 by 2. Okay. So you are supposed to pay this $25,000 at the end of period 2 based on the interest rate which is set in the end of period 1. Correct? Because end of period 1, whatever is the rate, that is what is applicable. Right. Now this logic is very important here. Why? Settlement amounts are determined by the value of the benchmark rate on the interest rate reset date. So interest rate reset. What is interest rate reset here? This date, 1/7. So on that day itself, you will know what is LIBOR, because you are taking that day's LIBOR, no? So you know that end of this period I am going to pay interest rate of 3% plus 2% spread. So by that logic, if at all there is any cap hit, let us say you enter into for same thing, you have a cap of 2.5%. That is, you will not pay more than 2.5. If the interest rate goes above 2.5, the seller of the cap has to reimburse you the money. So how much is your gain? Your gain is difference between those two, which is 0.5%. Now this 0.5 you know on this day itself. You know on 1/7 itself, even though this 3% is payable on 31/12, you know that you are paying 1.5% extra on 1/7 itself. So settlement amounts are determined by the value of the benchmark interest rates on interest date. Caps are cash settled and settlement amount is discounted to fixing rate. So when is interest payable? Interest is payable on 31/12, but we have figured out that you are paying 0.5% extra. 0.5% extra means probably that comes to how much? This is 5%, so 1% is 5,000, it comes to, let's say, $2,500. Okay, let's assume it comes to $2,500. This $2,500, you have to get the money from the cap seller on 31/12, but you know it on 1/7. So what do? You say on 1/7 itself you pay me by discounting 2,500 at 1 plus this market interest rate. Market interest rate is how much? 3% into 1/2. So you get some value 2,450. I am roughly putting numbers, I am not computing anything, okay, because here the goal is to understand this small concept. So you will be paid this 2,450 on the fixing date with respect to the next settlement interest, with respect to the next interest payout, okay, or with respect to the next cap settlement, that particular amount is settled on the interest fixing day itself. This is the point. What is the point here? Settlement amounts are determined by the value of the benchmark rate on interest reset date. I hope you have understood this part. And caps are cash settled. Caps are cash settled and settlement amount is discounted to the fixing date. Okay. Borrowers with floating rate borrowing enter into interest rate caps to restrict interest costs. This is the first thing I told you. Interest rate cap contract is a sum of caplets. So a cap contract is for entire 5-year, 3-year, 6-year, whatever is a loan period. If let's say the 3-year loan has 6 payments of interest, every half year 1. So the 3 into 2, 6. Each year 2, no, half year 1 means each year 2. So 3 years means 6 payments. Now for 6 payments, first interest payout is already known. So it is for 5 periods, 5 interest reset dates. With respect to those 5, a contract is entered with respect to those 5 put together. That is called as a cap contract. A contract is entered into with respect to all those 5. But for each individual interest payout, the transaction is called as a caplet. It is called as a caplet. So 5 caplets make 1 cap contract. Okay. Unless specified, all companies are made on actual by 365, and cap is like an option to borrow using an FRA. So I have a right to borrow at 2.5, but market has gone up to 3. So I am wise, so give me 0.5, but it is at my choice. So if interest rate comes down at to below 2.5, I have an option. So I will not borrow at 2.5. So it is like an option on an FRA, or it is like an option to borrow using an FRA, that it is such kind of a contract. Okay. Now how is this settlement amount arrived? I showed you the working. The notional principal into max of 0, RA minus RC. What is RA? RA is the actual spot rate of interest on the reset date, and RC is the cap rate. So if it is greater than the cap, then you get the payout into DT by days in a year. Okay, this is how you compute. Now this is a cap contract. What is an interest rate floor? Interest rate floor is exactly ulta. Interest rate floor is when, think of a bank which has lent on a floating rate. See, both these are with respect to floating rates only. I have lent something on a floating rate, and when you lend money, you get interest. Now I have a worry that interest rates will fall down, my floating rate will fall down, because of which I will get lesser interest income. So I am entering into a floor wherein I will say, if interest rates fall below a certain level, you pay me money. If interest rates fall below a certain level, you pay me money. That is called as a floor. A cap is what? If interest rates go above a certain level, you pay me money. A floor is if interest rate falls below a certain level, you pay me money. So you see, if market interest rate is less than floor rate, the buyer has right to receive floor rate minus market interest rate into notional principal from the seller. Okay, and if market interest rate is greater than floor rate, no problem. I need not do any payment. I as a buyer, I am don't have any obligation. Only if the interest rate is lower, the other party has an obligation towards me. But if interest rate is higher, I don't have any counter obligation to the other party. Same way, I will also, it is an obligation, it is an option, not an obligation for the buyer. It pays premium to seller to purchase the option, so I pay a premium upfront and do this. Floor rate is a strike or exercise price of the option, same stuff. Settlement amounts are determined by the value of the benchmark rate on the interest rate reset date. That is what I told you for cap also. Floats are cash settled and settlement amount is discounted to fixed rate, same logic. Lenders with floating rate borrowing enter into interest rate floors to ensure minimum interest income, which is what I was telling you. That this is typically entered into by banks. Interest rate floor contract is a sum of floorlets. So, individual contracts are called floorlets and all put together is called as a floor contract. Unless specified, all computations are made on actual by 365. It's an option. It is like an option to lend using an FRA. So, I have an option to lend to somebody using an FRA. If interest rate falls, I will still lend to you at a higher rate. So, I get the basic difference between those two. And what is it here? Here it is ulta. What is it? In the case of cap, we saw as RA minus RC. Whereas in case of floor, it is RF minus RA. Okay. So, if the rate is below the floor, then I get the money. So, which is why we are subtracting RF minus RA, which is actual rate. Okay. Now, this is broadly what is an interest rate cap and what is an interest rate floor. Now, let us also look at what is an interest rate collar, because once I finish, then I think we can solve few problems and then we can go back to the other concepts. It is a specialized combination of cap and floor. So, if you buy a cap and sell a floor, please remember, it is not buy a cap and buy a floor. It is buy cap plus sell floor. Okay, that is a collar. Now, it involves simultaneous purchase of an interest rate cap and sale of interest rate floor in the same index for same maturity and same notional. So, it is for the same maturity, same notional and same index. That is, both of them are for 6-month LIBOR. You cannot do one 3-month LIBOR, one 6-month LIBOR and then claim that they both are together a collar. No. A collar is one where principal amount is also same, buy a cap, sell a floor for the same, on the same dates for same notional amount and for the same interest benchmark. A collar protects from adverse change in interest rates on both high side and low sides. So, it protects you both on high side and low side. What is it? We'll understand. What is it? We'll understand. I'll explain it to you. Long collar is buying a cap and selling a floor, which is what I was telling you. Short collar is buying a floor and selling a cap. Okay, we'll come to this later. Zero cost collar is premium paid for cap is equivalent to premium received on floor. So, when you buy a cap, you pay premium. When you buy a floor, you pay a premium, but when you sell a floor, you receive a premium. So, when you buy a cap and sell a floor, there is an outflow of premium for the cap, inflow of premium with respect to the floor. Both of them offset each other. If they offset each other exactly to make it 0, then it is called as a zero cost collar or a special collar. The premium received from writing the call pays for the purchase of the put option. Okay. Very similar to what we have in call and put. This is like for cap and floor. Okay. And what is the payoff for a floor? Payment is an principal into max of 0, RA minus RC, that is actual rate minus cap minus, see, in case of a floor, what was the formula? RF minus RA, N max of RF minus RA, but here you have sold a floor, so it will be minus. So, the key term here is minus max of RF minus RA, whole thing into days per year. Now, let us understand why they do this simultaneous purchase of call and floor. Think of this scenario. I am a borrower and I have a loan of, let's say, LIBOR plus 200 bips, my favorite number. Okay. Now, I don't want, and currently let's say LIBOR is 5%. So, my interest cost today is 7%. I don't want my interest cost to cross, let's say, 9%. If interest cost should not cross 9%, then 9 minus 2, which is 7. So, LIBOR should not be crossing 7. Current LIBOR is 5. So, I will say I will buy a cap at 7%. Very good. Because see, typically nobody buys a cap, people buy a cap for the floating rate, not for the spread also. Please remember that. You buy a cap at 7% for this LIBOR, 6 months LIBOR. Okay, let's take 6 month LIBOR. Now, for this, let us say I have to pay a premium, and let's say this is a $1 million loan. Now, for this, I have to pay a premium, let's say, of 200,000. I'm just making up a number, random number. 200,000, that is 20% of my value of the loan. Why will I do this? For just some chutku small number, why will I enter into this contract? On the contrary, if you believe interest rates are going to go very high, okay, you don't think interest rates will fall, then what you can do is, you sell a floor. What is a floor? Floor is if interest rates fall below a certain level, you get paid. That is a buy floor. buy floor is interest less than floor, you get inflow. Sell floor is interest less than floor, there will be an outflow. That is, if interest rates fall below, let us take floor at 3%. You don't think that ever in the lifetime, after at least of this loan, interest rates will fall below 3%. 6-month LIBOR will fall below 3%. So what will happen if if you think it will not fall below? So you can say, I will sell a floor at 3. If anybody feels that interest rate will fall below 3, I am willing to compensate you whatever is the difference. If interest rates fall to 1, 3 minus 1, 2, I will pay you. So what happens? You are selling a floor. The other party is buying a floor at 3, you are selling a floor at 3. And what happens in this? Because you are selling a floor, you receive premium. Say you receive premium of 200,000. This is plus, this is minus. Both premiums cancel each other. And you have been able to restrict your interest cost especially with respect to LIBOR at 7%. So on the upside it is LIBOR, whatever is LIBOR plus 2, on the upside it is 7 plus 2. On the downside it is 3 plus 2. Why is it 3 plus 2? Because if it goes below 3, what is the cost of your loan? If it let's say it goes to 1%. What is the cost of your loan? 1% plus 2%, 3%. But there is this other fellow to whom you have sold a floor. He will say, boss, I am a floating rate lender. I purchased a floor, you sold a floor. You said if interest rates fall below 3, you will reimburse me. So what will happen? You have to reimburse the difference between this 3 and 1, which is 2. So your cost will only be 3. Even though the market rate is 1, you are supposed to pay this 1% to your lender. You will pay off 1% to your lender, but you will reimburse 2% to this other fellow to whom you have sold your floor. So your net cost again is your lender you have to pay 1 plus 2, and this another floor buyer you have to pay another 2, which is 1 plus 2 is 3, 3 plus 2 is 5. So your interest cost is fixed between 5 and 9. So you are operating between 5 and 9. That way you know for certainty that in your financials, P&L, balance sheet, your cash flow related stuff, everywhere, my interest cost is between 9 and 5. Yeah. Right? I have arrived at a rate wherein my costs are fixed at a specific number or in a range. So can you buy a cap and a floor at the same rate? You can, technically you can, but then what ends up happening is you end up, the premiums may not match each other. So let us say 6-month LIBOR is, I buy cap at let's say 5%, current LIBOR is 4%. I sell floor at same 5%. Now this probably has a $20,000 premium, this probably has a $10,000 premium. You may receive lower, pay higher, that is one thing. Depends on which way the interest rates are expected to move. Okay, that is one aspect. Second aspect is if interest rate goes to let's say 7 or 8%, what do you have? What happens? You make a gain. If interest rate goes below 5%, what happens? Your interest rate is fixed at 5. So typically what people do is they will sell floor at a slightly lower level because they want to take some advantage of reduction in interest rates. Okay, so this is what is a collar, which is basically a summation of buy cap plus sell floor. Okay, so now after having understood these two, let us go and solve the problem what we thought. I think the problem was some 9 or 11. Yes, the problem was 11. The problem was 11. This is a problem from CFA Institute material. This is not ICA material because I wanted to explain the concept. So I took some specific problems from non-CA material also. Let us read the problem. On December 15, DH Banks issues a $50 million 2-year loan floating rate liabilities. A bank issues. Bank is what? Bank issues means let us read. I will see how you figure out. The 4 interest payments are based on 180-day LIBOR plus 150 bips. The first interest is set today with payment 180 days thereafter. Okay. Each loan is 180 days after the preceding date. To hedge against rising interest rates, bank buys an appropriate interest rate cap. Who is bothered about rising interest rates? Someone who borrows. So when they issue a loan, basically they have issued a bond and raised money. Okay, they have issued a bond and raised money. Buys an appropriate interest rate cap with a strike rate of 4.75 to fully offset the initial cost of the cap. Bank sells a floor with a strike rate of 2.25. So I purchased something at 4.75, sold something at 2.25. Now what is the other aspect? Initial LIBOR is 3.4, assuming that in 180, 360, 540 and 720 days, LIBOR rates are 4%, 5.12 and 1.75. Calculate the net interest paid by the bank on each payment date and show all the cash flows leading to the next payment. Explain the cost of the collar. Explain the cost of the collar. First, 250 million loan, and I have also established that it is a loan that the bank has borrowed, basically is issued a bond. Okay, 2-year, 6-month LIBOR. If it is a 2-year loan, then how many installments are there? If it is 6-month LIBOR, see, If LIBOR is 6 months, then interest is also paid in every 6 months. Okay, that is a normal logic. So you have 4 installments, but for the 4 installments, for the first installment, or you have 4 interest service dates, but for the first interest payment that is due, interest rate is already fixed on the day on which you borrow. So there are only 3 payments to be made with respect to interest. So 6 months LIBOR plus 150. Cap is 4.75, floor is 2.25. Okay, so you have a cap, you have a floor. Now this cap is pertaining to LIBOR, not pertaining to overall cost of loan. Please remember. What are LIBOR rates they have given in 180 days? Initial LIBOR is 3.4. Initial LIBOR is 3.4. So day 0 LIBOR is 3.4. 180, 360, 540, 720. LIBOR is 4, 5.1. Then 2 and 1.75. So you have 4 LIBORs. Now see, on 720th day, this is a googly. Okay, 720th day means what? 2 years later. So on the day the last interest payment is due, when is it due? On 720th day. Assume that year has 360 days, because here they mentioned everything as 360 in terms of 360. What is the interest rate? Do you pay interest on last installment or last interest due at 1.75? No. On first interest payment, that is after 6 months, you pay it at 3.4. After 12 months, you pay it at the next number, which is 4. This is 6, this is 12, this is 18, this is 24. So 2% at 24 for 24 months is already fixed. This is just a googly to confuse you. Some people may make mistakes and use that rate. So that is why they have given it. So please be very careful. Now applicable rate is 3.4, 4, 5.1, 2. This is what I have said. So what is loan plus LIBOR? LIBOR plus loan is what is loan rate? LIBOR plus spread. What is spread? 150. So 3.4 to 4 plus 150, 4.9. 4 plus 150, 5.5. 5.5 plus 150, 6.6. And 2 plus 150 is 3.5. Now 3.44, 5.12. What is the impact of the cap? What is the impact of the floor? What is cap? If the rate goes above a certain level, and what is that level? 4.75. If it goes above 4.75, you will get compensated for the difference. So 3.4, 4, 5.1. Yes, at 5.1 you will get compensated. How much? 3.35%. What is the floor? Floor is 2.25. And remember, floor is a sell floor. If you are doing a collar, you are buying a cap, selling a floor. So if sold at 2.25, so if it is below 2.25, you have to pay somebody. So 3.4, 4, 5.1, 2. So 2 is below 2.25. So you have to pay somebody 0.25. Okay, so you have to write this particular formula. If you write, it is very good. The examiner will also know that you know the formula, because there are marks allotted to the formula. Okay, this is the impact of the cap, this is the impact of the floor. Now, if this is the impact of the cap and floor, what is your total interest cost? Total interest cost is, we have already computed here, 4.9, 5.5, 6.6, 3.5. So 4.9, 5.5, 6.6, 3.5. And you have this collar impact. 0.35 in case of the cap, it comes to you. 0.25 in case of the floor, it goes away from you. So this is your normal interest. You have the interest with respect to the collar here. So how do you compute normal interest? Is 4.9%. You take 50 million. 50 a million is 10. A million is 6 zeros. So 50 million is 7 zeros into 4.9%. This is for full year, divided by 2. You get 1.225 million. So that is how we got 1.225. Like that you compute for each of the periods, and here I have purposely done 1 by 2 because they have given the numbers in 180 day, 360 day. If they are given in 365 terms, I would have used 365 terms. So what is the total interest? You add 1.225 plus this, 1.375 plus this, 1.65 plus this. And how did I get the cap value? Simple, 0.35%, 50 million into 0.35% divided by 2, 87,500. So I add all of this, I get. Please note, when you have a collar, you have a buy cap, sell floor. For a cap, money comes in. For a floor, money goes out. So this 0.0875 is inflow, which is subtracted from 1.675. 0.0625 is an outflow, which is added to 0.875. So you do like this and arrive at the interest outflows. What else did they ask? Calculate the net interest paid to the bank on each payment and show all the cash flows leading to the next payment. That we have already showed. Explain the cost of the collar. What is the cost of the collar? Here the cost of the collar here is, what do you say? What is the cost of the collar? Here interest rate is between 4.75 plus 1.5 and 2.25 plus 1.5. 2.25, no, what is your collar floor strike? Yes. What is 1.5? 1.5 spread. This is LIBOR. So your interest rate is between 6.25 and 3.75%. This is how this collar is going to get you interest rate. Your interest rate will be in this range. So that is what we got now, 4.9, 5.5, 6.6. From 6.6 you are subtracting from 6.6 you are subtracting 0.35. So it is reduced below 6.6, which is 6.25. So exactly 6.25. And here 3.5 plus 0.25. So when I wrote here minus, no, minus is with respect to the cash flows. But with respect to the cost of the interest, it is plus. So 3.5 plus 0.25 is 3.75. So your interest cost it will lie, even for a floating rate loan, it is in a broad range of 6.25 and 3.75%. And they themselves said what? Cost. To fully offset initial cost, they buy a floor with strike rate of this 2.25. So explain the cost of the collar. The collar is zero cost and it gets you a rate of loan which is between 6.25 and 3.75%. Okay? Understood this? Now, after having understood this, let us look at other problems. We have solved 4 and 11. Next we have 13, 16. What are 13, 16? What is 13? 13 is a question on LIBOR, cap, so on and so forth. Yes, through cap. Okay, 13 is cap. Let us go look at 16. What is 16? Textile manufacturer, floating rate loan, expected rise, pegs is interest rate, peg is interest rate cost. This is also a cap. So 13 and 16 both are with respect to cap. So let us go and look at these questions. Now let us look at this question, question number 13. What is this question number 13? XYZ Limited borrows 15 million pounds for 6 months LIBOR plus 10% for a period of 24 months, same like previous one. The company anticipates a rise in LIBOR, hence it proposes to buy a cap option from its bankers at a strike rate of 8%. Okay, the lump sum premium is 1% for the entire reset period and a fixed rate of interest is 7% per annum. The actual position of the LIBOR during the forthcoming period is as under. Reset period 1, 9, 9.5, 10. You are required to show how far interest rate risk is hedged through the cap option, and for calculation work out figures at each stage up to 3 decimal points into the nearest pound. Okay. When they are saying 3 decimal, that is for interest rate, and a pound is for amounts. It should be part of working notes. Okay. So what is the loan here? 15 million. Premium is 1% paid over the period. Now this is a unique concept. What I have seen is typically they directly mention the percentage amount that you have to pay, whereas as far as institute material is concerned, they have said that if they have to pay 1% over the entire period, it basically means that you have to compute premium percentage into loan value by present value interest factor. That is 1% into 15 million, which is what? Which is 0.15 million, which is 0.15 million is 1,50,000. Divided by the present value interest factor to annuity. That is for these, for 3.5%. Why 3.5%? 3.5% is here basically 6% annum is a fixed rate. So this fixed rate, whatever you have over the next 4 periods, whatever is the premium is payable for at 1% of the value of the loan, which comes to 1.5 lakhs or 1,50,000. But this 1,50,000 is what you pay upfront today. If you were to compute an equalized annual cost, you remember in advanced capital budgeting questions we discussed about EAC, concept of EAC. If you do something like that, then you discount it by the present value annuity factor for, because there are 4 periods, 3.5 and 4, you get a present value factor of 3.673, cumulative present value factor. So per period, you are basically incurring 40,837 is the equalized annual cost of premium. Now, typically I have not seen this. I have typically seen that the cost goes 1 lakh. This 1,50,000 is what goes. No, people may choose to evaluate like this, but I have not seen it. Okay. Now, what are the periods? 3 periods, H2, H3, H4, and they have given 9, 9.5 and 10. 9, 9.5 and 10. What is the cap? You purchase the cap at what? Cap has been purchased at 8%. So, very good. All 3 you are going to gain. So, 8, 8, 8. Payoff is whatever is the difference between those two you will get. Whatever is the difference between those two you get, which is 1%, 1.5%, 2%. So, total interest is your 9 plus what was the spread? LIBOR plus 10. So, 9 plus 10 is 19 minus the cap payoff of 1. So, your interest cost is fixed at 18. So, always your interest cost is only 18. And what are the 3 things that they asked? You are required to show how far interest rate risk is hedged through cap option. It is fully hedged. Figures at each stage up to 3 decimals and amounts also they are requiring you to show. So, for each stage before the cap effect, it is 19, 19.5 and 2. So, which basically works to 1.425. So, how did I get 1.425? Basically 19% of 15 million. divided by 2. You get 1.425 million. That is this 1.425 million. And you get a cap payoff money that you get in, which is 1%, which comes to $75,000 or pounds here. So 1.45 minus 75, you get 13.5 million. So every time you pay, not 13.5, 1.35 million. So commas you have to always be careful. So 1.35 million. So every time you pay this 1.35 after adjusting for cap payoff. Now what is the net interest cost after premium? You may ask, sir, why are we doing it for 4 periods when it is actually to be, when there are only 3 payments, and why are we taking this 40,837 only 3 times? This unfortunately is an ICA question, and they have done it this way, which is why I was saying that typically nobody does this equalized annual cost wala funda. But anyway, it is what it is. I want you to specifically know that this is how they are doing, which is why I am solving this problem. So what happens? You add the cap premium. It is not a subtraction, it is addition. Why? Because you are making a payment. So 1350 plus 4837, you basically get 13.90387 or 1.39087, 1,390,837. So you add the premium and get the net outflow. Okay, this is not net, this is net outflow. And what is the cap payoff? 75,000, 112,500 and 1,50,000, which we have computed here. Minus the premium adjusted, you get this net amount that you have actually paid is this 2,14,899. So your cost, your cap premium value is what you have paid is 122, whereas the savings you made is 337. So you're getting a benefit of 214. Now this is one way of looking at it, but I typically feel that this kind of premium amortization over a period, I have not seen, as I said multiple times earlier. Okay, so now let us move to the next problem. What is the next problem? Problem number 16. What is this illustration 16? A textile manufacturer has taken a floating rate interest rate loan of rupees 40 lakhs on 1st April 12. The rate of interest at the inception of the loan is 8.5. Interest is to be paid every year on 31st March. In the month of October, the central bank releases following predictions about the interest rates likely to prevail in the future. Okay, on 31st March 13 at 8.75, on 14 at 10, 15 at 10.5, 16 at 7.75. Show how this borrowing can hedge the risk arising out of expected rise in the interest rate when he wants to peg his interest cost at 8.5. Assume the premium negotiated by both the parties 0.75% to be paid on 1st October and the actual rate of interest on the respective due dates happens to be on 31st March 13 at 10.2, then 11.5, then 9.25 and 31st March 16 at 8.25. How settlement will be executed on the respective dates. Now, this is for what period? They have not given period. So, we have to assume that it is at least a 5-year loan. Because if it is given 31st March 16, then say the rate is applicable for 16-17. That is till 31st March 17. Now, what do they want? He wants to peg his interest cost at 8.5. So, interest rate cap of 8.5. Okay. Now, this is projection. And this is actual. Okay, so projection is 8.5 for as on date, that is inception, which is on 1st April 2012. Then next year it is 8.75, 10, 10.5 and 7.75. Actuals are 8.5, 10.2, 11.5, 9.25 and 8.25. What is the cap? Cap is at 8.2. What is the current rate? Cap is at 8.5 and current rate is also 8.5. So now he should go long an interest rate cap to ensure interest rate borrowing is capped at 8.5. That is what we are supposed to do. A very simple question. Okay. Then show settlement will be done on executed on respective. No, it's not perspective or respective interest due dates. So premium to be paid is how much? You pay a premium of 0.75%. on 1st October 2012. So for the first year, it is already fixed at 8.5. So it need not, nothing needs to be accounted for, or rather there is no, as we discussed earlier also, for the first period there is no cap. Cap is typically not taken. It's only taken from the second interest payment period. So 0.75% into 40 lakhs is 30,000. This is how typically I have seen cap payments made. Okay. Then 12-13, 8.5% on 40 lakhs is 3.4 lakhs, which is very, very simple because first year the rate is 8.5. Second year is 10.2 But from 10.2, you have purchased a cap of 8.5. So you get the gain of 1.7. So 1.7% into 40 lakhs, you get a gain, which is 68 lakhs. And what is your total interest cost? You paid 10.2 to your original lender and you receive 0.68 from your cap seller. Okay, so you get 3.4 as the interest. Same way, next year also 3.4. Why? Interest rate has gone to 11.5. You have a cap of 8.5. So the gap is 3. The 3 into 40 lakhs, which is 1.2, which is 1.2 lakhs you get, whereas you initially make a payment of 4.6 lakhs, which is 11.5 lakhs into 40 lakhs for 1 year. So again, net 3.4. And last year, not last year, I think before last year, penultimate year, 9.25 lakhs on 9.25 and 40. 9.25% on 40 lakhs is 3.7. Again, you get a gain of 9.25 minus 8.5. You again the interest cost is net cost is 3.4. Now, what is this? They have given till 15-16. Now, is it 16-17? Is there any number? 16-17 on 31st March 16 is 8.25. Is that 8.25 number relevant anywhere? If we want, we can assume that it is a it's a 5-year loan. If it's a, I think they should have mentioned ideally it is a 4-year loan. 4-year loan. If it is a 5-year loan, then you have to compute. Otherwise, for a 4-year loan, this computation is sufficient. Okay, so this is illustration 16. It's a fairly simple. See, once you understand stuff in this chapter, now everything is simple. Once you understand the logic, everything will flow so smoothly. The thing is, get logic. Please don't ask me. I know a lot of students have reached out to me saying, sir, tell me tricks. How should I remember what to solve? Arey boss, I cannot explain like that. I know a lot of people want just the stepwise how to do it without understanding. I unfortunately am not built that way where I can explain to you stuff randomly like that without helping you understand the concept. I am really sorry. Probably that is the way it works for you. It doesn't work for me. And I don't think it should work for anyone, but it is your choice. Okay, my choice is very clear. You have to understand the concept. Without concept, there is no way. Even if you pass the exam, you will not clear the interview. Please be careful. 16 we have done. Next we have to do 19, 21 and 25. So before going to the next set of problems, 19 and so on, I gave you some numbers. Before going there, there are two more concepts that you need to understand. One is with respect to interest rate futures and second is with respect to swap. Okay, I've given good examples here. Let us try and understand what are these interest rate futures and swaps. Interest rate futures, the concept is slightly, both of them are simple only. It is not that any of them are tough, just that interest rate future is more, there is a slight theoretical aspect to it which you have to remember carefully, that's all. So let us see what it is. What is an interest rate future? It is an exchange traded product. Okay, all futures are exchange traded, forwards are OTC, we also know. It is cash settled, that also we know. Internationally, bond futures have delivery based settlement, whereas IRFs are cash settled, but in India both are same. As far as India is concerned, whether you use the word interest rate future or you use the word bond future, you are referring to the same thing. Internationally, bond futures are delivery based, whereas interest rate futures are cash settled. Whereas in India, both are same and we only have one product which is called interest rate future. It is what is it? It is a contract to buy or sell a bond in future at a predetermined price. So, interest rate future is a contract basically to buy a bond or sell a bond. It is not a contract on the interest rate. It is not a future on the interest rate. Here the underlying is an interest paying bond. Okay, interest paying bond. And it is used to hedge against risk of changes in interest rates. That is, I am agreeing to buy a bond or I am agreeing to sell a bond. So, the underlying is an interest paying bond. So, when you buy an interest rate future, you are agreeing to buy a bond. When you are selling an interest rate future, you are agreeing to sell a bond. The bond mentioned is not an actual security but an artificial or notional security. This is the most important thing. And this is true not just for India, even abroad also you have the same concept. That is, interest rate futures are created on artificial securities. Why are they created on artificial securities? I will tell you an example. If let us say you want to buy an interest rate future on 10% on let us say 7-year maturity government bond. Is there exactly a 7-year maturity government bond today? It may not be there. There may be a 6.5, there may be a 6.25, there may be a 7.5, 7.25, 7.75. Exactly 7 will not be there. It is possible. 99.5% of the time that is how it happens. So, you may have securities with balanced maturity of 6.5 years, 6.75 years, 7.1 years, 7.5 years. You don't have a security with balanced exact maturity of 7 years. So, what do? You create an artificial security which is for exactly this period of 7 years. What you do is you basically draw the interest rate curve. So, you draw a curve like this. Okay, so 6 years maturity is here, 6.5 is here, 7.5 is here. So, obviously 7 will be somewhere in between. So, this is tenure, this is yield. As tenure increases, yield increases and it flattens out. Now, in this particular interest rate future, you do not have a 7-year future exactly, which is why you are creating a 7-year future based on all this interest rate curve. And the future is traded on prices of this, on price of this. But that price is not there in the market. So, how will you do settlement at the end of the period, or how will daily trading happen? See, futures trading can happen based on buy and sell. It need not, there may be underlying bond may not exist, but you may trade based on whatever is the price applicable to a 7-year balance maturity bond you can do. But settlement, how will it happen? For settlement to happen, they do at the time of delivery, actual deliveries are made, are based on the conversion factor specified by the exchange. What is this whole conversion factor story? What they will do is, because you have used a balance maturity of 6.5 years, 6.75 years, 6.9 years, 7.1 years, 7.2 years, for all those bonds, they will say these are the bonds. Your future, whatever is your future, on the last day, it needs to be converted so that it is comparable against any of those bonds. Please note, your future needs to be converted. Those bonds need not be converted. Those 6.7, 6.9 and all need not be converted. Your future, 7-year balance maturity Government of India bond future, that needs to be converted by multiplying a conversion factor, and you arrive at a delivery price. This delivery price is the price at which you will take delivery. So, your delivery price at which you will take delivery of a bond minus the quoted price of the bond. What is the quoted price of the bond? That's 6.5-year bond, 6.7-year bond, 7.1-year bond. You will compare the delivery price of the bond that you have arrived in previous step. From that, you will subtract the quoted price and arrive at a gain or loss. These two steps, a lot of students forget, which is why I am trying to re-emphasize on this. You multiply conversion factor only with the future price. You arrive at some number. From that number only, you subtract the quoted price of the bond. Okay, and you get a gain or loss. The bond which shows the lowest loss or one which has highest gain is called as the cheapest to deliver bond, and settlement is based against that, and net cash settlement happens of that particular bond. Let us take an example. There is a bank which sold 7% IRF underlying notional 7.5% coupon bonds. 7% interest rate future on a notional 7.5% coupon bonds. Details of eligible securities that came delivered as below. So, recommend CTD security, future price settlement price is 10,000. So, if you are anyway creating an artificial security, your IRF can be at a different rate, but the underlying bond can be a 7.5% coupon bond. Exactly. Right. Not only maturity, even the underlying bond can have different coupon. You can use that as an underlying with respect to the future that you are buying and selling. So, you see, there is a 6.65% security, then 6.8, 6.85, 8.4, 8.85. Each one is with different maturity. What is the quoted spot price? There are some quoted spot price, 9,000, 8,000, 9,000, 11,000. Conversion factor is given. Please remember, conversion factor is not multiplied with this. Conversion factor is multiplied with the futures value. And future settlement price is 10,000. So, 10,000 into 0.9060, and please note, conversion factor is not divided, it is only multiplied. So, 10,000 into 0.91, 10,000 into 96, 1.17 and 1.24. This, you get some value. What is the value that you got? You got these values: 9060, 9195, 9643, 11743, 12428. Then, what is the quoted price of the bond? They have given here. These quoted price you plot beside that and see which bond you have lowest loss or highest gain. Okay, if there is a gain, you choose the gain. So, what is the loss? 9060 minus 9264. Loss is how much? 204. Then there is a gain of 9195 minus 8775, a gain of 420. Then loss of 80, gain of 210 and gain of 411. Either highest loss or lowest gain. So, it is not either or. if you are given a bunch of losses, you will choose the lowest loss. If you are given a bunch of gains, you will choose highest gain. If you are given a bunch of lowest loss and highest gain, you will choose the highest gain. That is the understanding. I didn't realize that there is an interpretation like this until a student asked the query in in our app one day. Okay, sir, they said either low loss or high gain. Can I choose the low loss or high gain? No, no, no. You have to choose only one, and it has to be the highest gain if both losses and gains are given. So 420, this is the bond, very fancy number. Highest, this has the highest profit. So this is the bond against which you will choose to settle, okay, against which the settlement will be made. That is this bond, 9195 rupees worth of bond on which you are going to make a gain. So against this bond of 6.8%, this is the cheapest to deliver bond where you have a maximum gain of 420 rupees. Okay, so this is one particular question. I think there are a couple of more questions on this. We will come to that. We will when we are going there. But the other aspect that I want to discuss with you is on interest rate swaps. What are interest rate swaps? Let us read and understand. Let us go back actually to the first few pages where we have read, what all have we discussed so far? We have discussed about interest rate, which is just now I discussed. Interest rate options I have discussed. Swaptions are still there. We'll come back to swaptions. We have discussed about interest rate swap. In that you have coupon only swap, principal only swap, cross currency swap, interest rate cap floor. This we have discussed. The special call also I have discussed. Now we are coming to interest rate swaps, and we also have swaptions left. These are the two aspects that are left. Let us first go and see what is interest rate swap. Then I'll explain to you what are the various kinds of interest rate swaps that are available. Then finally swaptions. Then we will go to problems. What is an interest rate swap? So interest rate swap is one where there are two parties and a dealer. So I am there, you are there, I am one borrower, you are another borrower, both of us have no linkage, there is a dealer in between. Now I have a floating rate loan, you have a fixed rate loan. Let us assume same amount, okay, they are done, these kind of swaps are done only when they are same amounts, okay, and both of us have same credit rating also, okay. I am a fixed rate borrower, you are a floating rate borrower. But I want to convert my loan into floating rate loan. You are a floating rate borrower who wants to convert into fixed rate loan. So both of us have, we have something, we want something else, and they both match. What I have, you want. What you have, I want. Then a dealer comes in between and says, I will swap your loan interest rate obligations. I will swap your interest rate obligations. So in an interest rate swap, you have two parties. As I said, one party has a fixed loan and they want to convert into floating. Other party has a floating loan which they want to convert into fixed, and in between there is a dealer. Now they agree to exchange payments index to do different interest rates. That is, I will take LIBOR plus 200, other party has taken 8%, but then we both will agree to exchange the payments with respect to the loans. Payment is computed on notional principal amount of swap and net cash settlement is done. I will explain this to you. We will take an example. It is easier to understand that way. Usually involves exchange of liability with fixed or floating rate for a liability with floating or fixed rate. Now, what they mean is, let us say there is X limited and there is Y limited. X limited and both have same credit. Okay. So, X limited, let us say is based out of India. They are based out of India and this is country, and this Y limited is based out of US. Okay. Now X limited, they have a subsidiary in US, okay, which requires a USD loan of, let's say, $1 million. $1 million, let's say the exchange rate is 85, which works out to 1 million is 10 lakhs. 10 lakhs into 85 is 8.5 CR. Okay. This rupees 85 per USD. Okay. Whereas this Y limited, which is based out of US, has a subsidiary in India which requires an INR loan of how much? Exactly 8.5 crores. Okay. So they require, this X limited requires 1 million, Y limited subsidiary requires 8.5 crores. Both are equivalent on the day of on when they want to actually borrow. And X limited, when the subsidiary tries to borrow in US, it is getting a loan at LIBOR plus 300 bips. Let me not take LIBOR, I will take SOFR, okay, because so I told you that LIBOR is no longer there. So SOFR only, right? What is the benchmark? SOFR, USA is SOFR. So SOFR plus 300 basis points. Let's take this as a 1-year loan. And same X Limited, if they were to borrow, it's a fully owned subsidiary, so the credit rating is same as X Limited and X Limited subsidiary. If they were to borrow in India, they will get it at 5% fixed in INR. Okay, this is in USD, this is in INR. Whereas exactly ulta thing is happening for Y Limited. If they borrow in US, they are getting it at SOFR plus 50 bips. And if they borrow in India, they are getting it at 8% INR fixed. So you see what is happening? I want to borrow this, or X wants to borrow this. Y wants to borrow fixed. Okay. X wants floating. Y wants fixed. Now, if X borrows floating, they are going to get it at SOFR plus 300. If Y borrows fixed, they are getting it 8%. But if X borrows at fixed INR and Y borrows at floating, and then they both exchange the liabilities. That is because amount is same 8.5 crores. Right, 8.5 crores on day of initiation, 8.5 crores is equal to $1 million if you divide by 85. So, there is a good amount of saving. Now, how this saving is computed, all of that we will see. I will explain you this example, or there is another example also I have given. But the idea is both these parties, instead of taking the loan that they are originally supposed to take, they will take some other loan. Why? Because, and they will take some other loan, and that loan they will swap out with the loan that they ideally want to take. This fellow wants to take a floating loan, this fellow wants to take a fixed loan. But X will take a fixed loan and swap it out, or X will take a fixed loan and swap it out, and Y will take a floating loan and swap it out. This is basically what interest rate swap is. When you say swap it out, I will explain what we mean by that also. But first, let us understand other aspects related to this. What are the other aspects? Currency swap or cross currency swap used to hedge ECBs with interest rate and exchange fluctuation risk. This is a swap where there is a currency element as well as interest element. Even in our example, we saw there is an interest element, then there is a currency element also involved. Okay. Mumbai Interbank Forward Offer Rate, a MIFOR swap, is a composite rate with USD LIBOR and USD INR premium as its forward premium as its component. So this is a Indian context. If you want to convert a rupee, if you want to convert a dollar variable into rupee fixed, which is exactly what that X and Y scenario was, you enter into a swap called MIFOR swap in India. The name of the swap is MIFOR. MIFOR represents the cost of borrowing in US dollars and swapping the same to INR, synthetically representing the domestic term interest rate. So the interest rate what you get by swapping out a USD floating loan into a INR fixed loan basically reflects the domestic term interest rate. That is, for that period, what is the interest rate that it reflects, or it is very close to that particular rate. The swap dealer who facilitates this swap gets a brokerage. So whenever you have a swap between X and Y, there is one dealer fellow, some banker, he will get some brokerage. Then the cost of brokerage fee is considered to determine the overall benefit from the swap, and IRS is equal to CF, series of FRAs. First, let us understand this point. If there is a cost of brokerage, you deduct the cost of brokerage from the total savings that you make and arrive at what is the net savings. You will necessarily have to consider into fact that there is some cost going to be attached to this. That is first part. Second part is IRS is a series of FRAs. What is IRS series of FRAs? This is a blanket statement. I mean, what does it mean? Interest rate swap is equal to series of FRAs. Why do we mean by that? See, in previous case, we said, where was that? Interest rate cap. Interest rate cap, we had some text, no, like this only, some fancy text. Is like an option on an FRA or something. Yeah, see, cap is like an option to borrow using an FRA. Whereas when it comes to IRS, we are saying IRS is a series of FRAs. What do we mean by IRS being a series of FRAs? So, what happens in an FRA? I agree to borrow at 3%, but market rate by that time, because it's a floating rate, I am agreeing to borrow at a fixed rate, market rate is floating, which has gone up, let us say to 4%, then I will receive 4, I will pay 3, net settlement is 1%. Same logic happens in IRS also. That is, I have a floating rate loan of let's say 3%, I ideally have to pay 3. But what is happening? I am swapping it out, wherein I am saying that I don't want to pay 3, you reimburse me 3, I will pay you 4 if floating rate is 4. So, the net settlement of the 3 and 4 happens. So, each individual IRS swap payment transaction related to interest is basically an FRA. So, IRS, which is why, is a series of FRAs. There are 5 FRAs you are entering into today, or you are entering into an interest rate swap. So, you can exclude the currency value here, okay. Think of fixed versus floating, IRS is a series of FRAs. Now, Let's take an example, like what I was just telling you. IM is an American firm having its subsidiary in Japan, and JI is a Japanese firm having its subsidiary in US. Okay, they face the following interest rates. IM wishes to borrow at USD floating and JI at JY fixed. The amount required by both companies is same on current exchange rate. A financial institution requires 25 bips as commission. The companies agree to share the benefit loss equally. You are required to find out whether a beneficial swap can be arranged. What is the rate of interest for both? So, fundamental issue with respect to a swap is whether a swap can be arranged or not, right? How will we see it is arranged? You see, IM, and here they have given the details, okay, they have given the cost. USD floating rate for IM is LIBOR plus 50 basis points, whereas for same thing for JI is LIBOR plus 1, okay. In JPY fixed, for IM is 3%, whereas for JI it is 4.25, okay. Now see what is happening. First question that they asked, whether a beneficial swap can be arranged. How can it be arranged? A swap can be arranged because combined cost of loan after swap is cost of loans originally available. What is this cost of loan originally available? See, IM is in subsidiary in Japan, and IM wants to borrow floating. What they desire is USD floating. What JI desires is JPY fixed. You take USD floating, which is LIBOR plus 0.5, plus JPY fixed is 4.25. I want this, he wants this, IM wants this, JI wants this. What is the cost of that? Combined cost of loan originally available is LIBOR plus 0.5 plus 4.25, which is LIBOR plus 4.75. Correct? Very clearly understand what I am getting. Okay, IM wishes to borrow. So, this is what I ideally want to borrow. Okay, this is what I want. Okay, what I want, it is going to cost me LIBOR plus 4.5. Now, instead of that, if I borrow at 3% and JI borrows at LIBOR plus 1, okay, if I borrow at 3 and JI borrows at LIBOR plus 1, what will happen? The cost of the loan will be LIBOR plus 4. So, the total cost of the loan is LIBOR plus 4.75 plus LIBOR plus 4. Is there this is what I originally want. This is what I am getting. Is getting less than want? Yes. Getting cost of loan after the swap, this is what I am getting, is less than what I want. Yes. If these two values are together, when you add the cost of what I want and when you add the cost of what I am getting, if what you are getting is less than what you want, right, or what is originally available, then a swap is possible. So, what will happen? IM, instead of borrowing it at floating at LIBOR plus 0.5, which is what they originally want, they will borrow at fixed of 3. And JM, instead of borrowing at 4.25, they will borrow at LIBOR plus 1. Even though they don't want that, they will borrow and then they will swap. How will they swap? IM will borrow fixed even though it wants floating. JM will borrow floating even though it wants fixed. Agreed? Then they will swap the loans. So, after I take the loan, I will say, okay, now I have borrowed 100 crores, you have borrowed 100 crores. My money is in US dollars, your money is JPY. You want US dollars, so I will give you US dollars. I want JPY, you give me your JPY. So, you are swapping the complete loan. Once you swap, I will say all the payments with respect to that you have to make. But as far as the lender, original lender is concerned, original lender will come back to you only. He will not, just because you have borrowed and swapped out the loan, IM has borrowed and swapped it with JI, lender will not go to JI. Lender will come to IM only. So, IM only will have to pay the interest. But the accounting effect of it or the net effect of it, how it happens, let us see. Total savings is, gross savings is L plus 4.75 minus L plus 4, which is 75 bips. Dealer commission is 25 bips. So, net savings is 25 bips each, which is 50 bips by 2, which is 25. How is 50? 75 minus 25. Now, what is the key point? A swap is not possible if above condition is not satisfied. Also note, both loans cannot be taken by same party. The reason why I am mentioning this is, there was one question in ICA exam once, where they gave a situation where such kind of a swap was not possible. But in the suggested answer, they gave that swap is possible. So, it was a blunder. It is an absolute blunder. I genuinely think that ICA should feel very sad about that suggested answer. Anyway, now how will you share this 25 bips? How does this work out? So, see, please note here we are talking about same amount, equivalent amount in USD terms. Whether you convert it to JPY or whether it is in USD, the value is same. Both parties have same credit rating. One is getting fixed, wants floating. One is getting floating, wants fixed, which is what they are swapping out. So, what will we do is, IM will borrow fixed even though they want floating. So, they will borrow fixed. So, when they borrow fixed, they only have to repay the fixed. And JM will borrow floating. Even though they want fixed, they are borrowing floating. What they do is, out of this 3%, from whatever this 3% is there, I have borrowed at 3, IM has borrowed at 3, but when I have borrowed at 3, who is responsible to pay this 3? I have borrowed and I have given off the loan to JI, so JI will pay them 3. But I have written 3.875, why have I written 3.875? You will understand this as we move forward. IM will get 3 from JI, and JI has borrowed at LIBOR plus 1, so IM will pay JI LIBOR plus 1. So basically, for a moment, keep this as 3 instead of 3.875, you will understand it slowly. This 3.875 is what JM will pay to IM, and IM will pay LIBOR plus 1. So both parties, even though I have taken original loan, I am paying your interest for your loan to you. You pass it on to your lender. You pay me my interest that I have to pay on my loan. I will pass it on to my lender. Okay, so what has happened? How much will you pay to the counterparty? That is, in first case you are receiving 3.875 and you are paying LIBOR plus 1. Now, what is the net effect? What is the net effect? You have to pay to your lender 3. Out of that, you are getting 3.875 from JI. Then you also have to pay to JI LIBOR plus 1. So, what is this? A minus B plus C. This minus B plus C. So, this is a net cost. When I am talking cost, I am not taking negative number, I am taking positive number. Okay. So, LIBOR plus 0.125 is my cost. For the other fellow, what is the cost? I am receiving LIBOR plus 1, I am paying 3.875, I am also paying LIBOR plus 1 to my original lender from whom I have borrowed at floating. So, my net cost is 3.875. My net cost is 3.875. Even though I said 3, I am referring to 3.875, wait, you will understand. Now, from this, for IM, cost is LIBOR plus 0.125, for JM it is 3.875. What is the dealer commission both have to pay? Dealer commission, they said it has to be shared equally. 25 bips is the dealer commission, which has to be borne by each equally. So, both have to pay extra 0.125%. 0.125%. So, 0.125, 0.125. What is the cost for IM? Cost for IM is LIBOR plus 0.125 plus 0.125, which is LIBOR plus 0.25. And for JI, it is 3.875 plus 1, which is 4. Now, what is the original loan that I would have ideally got had I borrowed my own floating? I would have got it at LIBOR plus 0.5. And what would this JI fellow would have got it? Would have got it at 4.25. Now what is happening? Even though I would have got it at LIBOR plus 0.5, I am now, because of making all these payments swapping, I am getting it at LIBOR plus 0.25 only. So I made a savings of 0.25. So I have gained 0.25. What is it for JI? Originally I would have got it for 4.25, but because of all of these activities, gymnastics, I am paying only 4. How much am I saving? 0.25. What did we save here? Net savings is 50, which is saved by both parties, each 25, 25. So this is how this 25 is shared. Now, how did I arrive at this 0.25 and what is the relation to this 3.875? Ideally, you should pay 3.875 only. What happens is, I first arrived at this 0.25 and back worked so that how much is the money that I have to receive from counterparty so that my net savings is 0.25. So I worked backwards. Instead of taking it at 3, I have said I will take it as 3.875. So you have to work backwards. That is, you start here and then work backwards. You see, instead of receiving from counterparty 3.875, can you also receive from counterparty only 2.875 and pay LIBOR only, not LIBOR plus 1? Yes, that is also possible. Or can I pay to, if I receive from counterparty 3, can I pay here LIBOR plus 0.125? That also can be done. So you can do any way. See, I don't know if you have understood what I am saying. 3 is IM's payout. Okay, 3 is minus. Okay, from to the original lender. Then 3.875 is received from JI. Then L plus 1 is pay to JI. So this is plus, this is minus. What is the net effect of all of this? Net effect of all of this is minus L plus 0.125. Okay. So minus means because it is an outflow. Now this L plus 0.125 can be adjusted anywhere, no? So this is a fixed number. This I have to pay to my original lender. This I cannot change. So this, to arrive at this 0.125, I can adjust this anywhere, no? So what will I do? Either minus 3 and I can make it as plus 2.875 and minus L. What will happen? Same thing. I will get minus of L plus 0.125. Correct? Or you can do it other way also. That is minus 3 and here it is plus 3. That is, instead of receiving 3.875, I will receive only 3. Then what will happen? I will pay L minus of L plus 0.125. What will happen here? 3 gets cancelled, again minus of L plus 0.125. So it can be structured in any way, and ideally in exam you will get marks whichever way you write, whether this or this or this. Okay, anyway, if your answer, eventual answer is this, you will get marks. Okay, this is how a swap is structured. This is how a swap is structured, and I have given you now, assuming that both the parties, there are two parties, both the parties have same amount of loan, both the parties have same credit rating, one wants fixed, other wants floating, they both are swapping out their loans. This is the explanation or this is the circumstance, or this is the scenario for which I have given explanation. Now, let us go and understand, there are 3 or 4 more points. There is something called coupon only swap, principal only swap, and cross currency or surplus swap. What is this? A coupon only swap is, it is simple fixed to floating. Now here in previous case, JI and IM, both of them are people who are dealing with each other, there is a dealer in between. Okay. Typically, you don't even know, quite a few times you directly deal with the bank. Bank is the counterparty, they do the floating leg or fixed leg with other counterparty, you don't know. Okay. I deal with bank, bank deals with them, I and the other party don't know each other, only the bank is the in-between person. So that kind of scenarios also happen. So what you do, when do you do that? When you have a floating rate loan, let's say I have LIBOR plus 125 bips. I want to convert it into a fixed loan. What do? You go to a bank. Bank ko kya karna hai, they will figure out. You will say, I want to hedge this. I want to convert it into fixed. So let us say this is a USD loan. I want to convert it into USD fixed. Banker will say, this loan ka coupon is what? Interest payment. Only with respect to the interest payment, I will hedge. So all the upcoming interest payments, instead of you have to make LIBOR plus 125, you make LIBOR plus 125. I will reimburse you LIBOR plus 125, but I will convert into fixed. That is, every month you pay, every interest installment you pay me 3%. 3% in what terms? In USD terms. Okay, so my outflow is 3%, my inflow is L plus 125, my outflow to my original lender is L plus 125. So original lender L plus 125, inflow from banker, both of them get cancelled, my cost of my loan is 3% fixed. So this can be done from fixed to floating or floating to fixed, and it is only coupon. I am referring here only to the interest component. Why am I being so specific about interest component? Arey Baba, in loans you also have principal component. Even in the previous example what we saw, we never discussed about principal. We just said ki, there is a swap loan, there is a loan interest cost fixed and floating, and we just assumed that the principal, how will principal happen? I said principals will be exchanged between both the parties. Now if you go to a bank and say that I want to enter into a loan, I want to enter into a swap where I already have a loan. For that loan, there is a principal amount also due, right? You have to repay the principal after 3 years, 2 years, 1 year, something like that. How will you hedge that principal payment? And why do you need to hedge the principal payment? You will hedge principal payment if it is in foreign currency. Only if it is in foreign currency, you need to hedge the principal payment. No, see, interest rate, anyway, you are arriving at 3%. You are converting L plus 125 into 3% fixed floating to fixed. But what is the necessity for you to hedge principal? You will hedge principal only when there is a currency swap. So, when you have a currency swap, you will enter into a principal only swap. What is a principal only swap? That is, you are hedging only principal. Interest rate, what will you do? We will see it later. Either I will enter into IRS, I will not enter into an IRS. That is a different matter. Right? Principal amount I want to hedge. What do you hedge it for? Currency risk. If you are hedging for currency risk, what kind of a swap is this? This is actually a forward agreement kind of a thing. Okay, you are entering into a swap or you are entering into a contract to buy some US dollars at a predetermined rate today itself. It is a forward contract, simple forward contract. So, principal only swap is I give you $10 or I pay you, so let's say I have taken a 10 million loan. Now, I don't know what is the exchange rate after 2 years, 3 years, 4 years. So, I will say we will freeze the exchange rate at 85 or 86. Every time my principal repayment is due, installment is due, I will pay you 86 into $500,000. What will you do? You will give me $500,000. If market rate is 87, I don't care. I will pay you 86 into $500,000. You give me $500,000. Okay, like that you will keep getting dollars, you will keep paying fixed amounts in rupee terms, and you will pass on the dollars to your original lender. That's called a principal only swap. Now, in coupon, we have hedged only the interest. We have not hedged the currency portion of the interest. So, I have a USD loan, floating. So, what are the issues I have? I have to convert floating to fixed, correct? Then, I am an Indian corporate. So, I have to convert this fixed USD interest to fixed INR interest, correct? This is part 1, this is part 2. This is coupon only swap. Then part 3, my principal repayment I have to hedge for currency risk. So here I am hedging interest rate risk, here I am hedging currency risk with respect to interest, here I am hedging currency risk with respect to principal. So a POS is a principal only swap which hedges for only the currency element of principal repayment, and IRS is a swap which hedges only for the interest portion and not the currency portion. If you combine all three together, it is called as a circus swap, SIRCUS, combined interest rate and currency swap. So combined interest rate and currency swap. So this is called as a circus swap, where you hedge all three aspects, the interest rate fixed to floating, the forex element of the interest rate, and the forex element of the principal component that repayment has to be made. This kind of swap is called circus swap. Okay, it's also called cross currency swap. Okay, so we have discussed about this. We have discussed all these three. Then there are some more elements I need to discuss on this particular topic. Yeah, other aspects I want to discuss is types of IRS. Now, when I explained to you about IRS or interest rates or generally swaps per se, the explanation that I gave is with respect to foreign currency related loan, which is why and a floating loan, which is floating to fixed, and then currency element. Now, you can also have different way of looking at it. That is, one is called plain vanilla swap. What is plain vanilla swap? It is converting floating to fixed or fixed to floating on notional principal. Purely, a simple IRS is called plain vanilla. Basis rate swap, that is two different variable rates. Example, 3-month LIBOR with 6-month LIBOR. How do you do that? So let's say I have taken a 3-month LIBOR loan. So I have to service interest every 3 months, but I don't want exposure to 3-month LIBOR. I want to make it 6-month LIBOR. So what I will do is, I will enter into a swap with a party. That party will pay me 3-month LIBOR every 3 months, and I will pay that party 6-month LIBOR every 6 months. So that kind of swap where you are changing the basics, underlying basis of the interest rate, what is there from one index to another index or one variable to another variable, it is called basis swap. Then you have asset swap, that is exchange fixed rate investment, that is bonds with floating rate assets, that is an index. So you basically are swapping out assets itself, that is you have a bond with a floating rate index. So you are basically swapping the returns of those two. Then you have amortizing swap. Amortizing swap means in a swap, I have told you initially that there is a principal repayment after 3 years for which I need to hedge. But principal can also be repaid, like your EMI, housing loan EMI. Every time when you pay EMI, you pay interest also, you pay principal portion also. So there can be cases where principal amount is also amortized over a period of time. So amortizing swap is one which considers even these amortization of the principal values also, right? So what happens when principal value keeps declining, your interest portion also reduces, correct? So the fixed to floating, the interest rate, the fixed to floating conversion will happen on a lower principal value, not on a fixed notional principal, but a reducing notional principal value. So such kind of a swap can also be done. So this is types of IRS. This is another way to look at IRS. Okay. Then we have one more concept called swaption. This is a very interesting concept called swaption. What is swaption? Effectively an option on forward start IRS. That is, I will take an option today to enter into an IRS with you at a future date, where I pay you floating of LIBOR and receive fixed of 3%. For that, I am buying an option today. That kind of an option is called swaption. That is exact terms like the fixed rate, the floating rate in reference interest rate, and terms are established upon conclusion of this swaption contract. So I have an option to enter with you. The 3 month into 5 year swaption means an option to enter into a 5-year IRS 3 months from now. The option period refers to the time which elapses between the transaction date and the expiry date. Then swaption premium is expressed as BIPs, and it can be net cash settled. So these options also can be net cash settled. What are the uses of swaptions? It is useful to borrowers targeting an acceptable borrowing rate, useful for speculation purpose or to hedge, useful for borrowers targeting an acceptable borrowing rate. Then swaptions also provide protection on callable or puttable bond issues. I think this is a repetition, ignore this. Swaptions also provide protection on callable or puttable bond issues. Okay, I don't want to get into this in detail because this is again why callable, why puttable, how will this provide protection, all that we'll discuss later. All that is not relevant for us from an exam perspective. Just please remember these are the uses of the option. How are swaptions priced? They are priced using probability based forecast of zero coupon yield curve. So you have a yield curve expectation based on the various probabilities of interest rates where they will where they may end up, right? You use the option theory to price that kind of swaptions, okay, and they are done in basis points. Then an option to enter into interest rate swap. It gives the holder the right but not an obligation to interest rate swap at a specific date in the future at a particular fixed date and for a specific term. Okay, a fixed rate payer or call swaption, a fixed rate receiver or a put swaption. Okay, and a fixed rate payer means a pay fixed, receive floating. A fixed rate receiver means receive fixed, pay floating. These are the types of swaptions that exist. Then you have something called as overnight index swap. This is especially in Indian context. That is, let's say there is a bank. Okay, the X bank enters into a plain vanilla OIS, that is overnight index swap, on a principal of 10 crores and agreed to receive MIBOR. Okay, so agreed to receive MIBOR means I am swapping so that I receive MIBOR and I pay fixed. Okay, overnight floating rate for a fixed payment of principal. The swap will commence on 3rd August Tuesday and run for a 7-day period. Irrespective MIBOR rates for Tuesday to Monday were as follows. So 1, 2, 3, 4, 5, 6. They gave only 6 days, but the swap is for 7 days. Why 7 days? Because for Sunday the market is closed. If X bank received 317 net on settlement, calculate fixed rate and interest under both the legs. If Sunday is and assume Sunday is a holiday, and work in rounded rupees and avoid decimal working. So what happens is, basically there is a 10 crore swap on a principal of 10 crore. There is a swap. What is this? 7.75. I have written down all these interest rates. Tuesday, Wednesday, Thursday, Friday, Saturday, and Sunday also same rate as Saturday. So you have 7 interest rates. Now in OIS swaps, basically overnight index swaps, the interest gets accumulated to the principal value, because any borrowing or any particular call money borrowing. So MIBOR is typically the rate used for call money between banks. Okay, for borrowing between banks they use MIBOR. So this 10 crores original borrowing, the interest which got accrued and is not paid gets added to the principal. Okay, it is daily compounding, right? So you compute interest on every single day, okay, on the previous day's closing balance. And on Sunday also interest is typically charged. Okay, you cannot say I will not charge interest on Sunday. On your housing loan EMI, you pay interest on for the day that is borrowed, also for Saturday, Sundays also. Okay, then what is the interest? The total interest that you have to pay is this for each day, and total interest paid is 153,745. This is what you have worked on based on the interest rates they have given. Now, but the bank received 317 net, meaning they paid this, okay, and they were supposed to receive a higher sum. What is the higher sum? 153,745 plus 317. They received, they were supposed to receive MIBOR for a fixed payment. So they were supposed to receive, so this they receive, so they pay is, how much would have they have paid? They have to pay 317 less, so that they get 317 extra. So 153,745 minus 317, which is 153,428. So they are supposed to pay 153,428. They are supposed to receive 153,745. So net 317. So what is the rate at which, fixed rate at which a 7-day loan on 10 crores will get you how much? 153,428. So you work backwards. So 153,428 divided by 10 CR into 3,765 by 7, you get it as 8%. Here there is no compounding. Here is a fixed rate. Okay, so there is no daily. Again, please don't say that daily compounding is there for this. No, that is not. It doesn't work that way. It is fixed rate at 8% for that entire 8-day period. And if on Sunday also interest is computed, the interest for Sunday is 217. Otherwise, it is 21882. What do you mean by that? See, if you add this 21,882 to this and then compute interest on at 7.98%, then the interest for that day is 21,887. Otherwise, if you don't add the previous day's accumulated value and just take directly the interest, you will take the same interest value. Okay, so this is an overnight index swap. So with this we have completed all the theoretical aspects and all the various varieties of swaps, then options, everything, right? We have covered everything: swaptions, interest rate collar, cap, floor, everything is done. Everything is done, absolutely. Now we can directly go ahead and finish off all the balance problems. Till where have we finished problems? We were at this, I think 16, 19 and 21. Let me go and check. 16, 19, 21. 19 is one. Then we have not done. This is 19. We've just now solved this problem. I explained this to you, that OIS concept. So this anyway is done. 16. Yeah, 16 is done. 19 I have explained you when I was explaining the concept. Then 21. 21. Let us look at question number 21. So this is November 20 question, November 20 new syllabus question. Let us see what it says. IB, an Indian firm, has subsidiary in Japan, and Zaki, a Japanese firm, has subsidiary in India. Very similar to what I saw. And they face the following interest rates. Company IB is getting a floating rate loan of BPLR plus 0.5 and a fixed rate loan of 2. Zaki is getting floating of BPLR plus 2.5 and floating rate fixed rate of 2.25. What is it that they want? IB. Now Zaki wishes to borrow a rupee loan at floating rate. So Zaki rupee loan at floating rate. This is what they want. And IB wishes to borrow JPY at fixed rate. That is 2% is what you want. So what you want costs how much? BPLR plus 2.5 plus 2, BPLR plus 4.5. Now what is this value? BPLR plus 0.5 plus 2.25, BPLR plus 2.75. So the amount of loan required both firm is same at current exchange rate. Institution may arrange a swap at 25 bips. Gain if any needs to be shared by firm. You are required to find out whether a swap can be arranged, should be beneficial, what rate of interest will firm end up paying. So what you want is BPLR plus 2.5 plus 2, which is BPLR plus 4.5. Summation of these two. What if you swap, what will you get? BPLR plus 2.75. And you also add 25 bips for dealer commission. Still then BPLR plus 3. So post swapping, you will get at BPLR plus 3, whereas before swap, you're getting BPLR plus 4.5. So yes, swap is possible. Whether a swap can be arranged, yes, swap is possible. Okay, what rate of interest will firm end up paying? Let us see. Let us see. IB wants yen fixed and Zaki wants INR floating. So total loan required is BPLR plus 4.5. Alternatively, if IB gets floating and Zaki gets fixed, cost would be this much. Total saving is swap is entered is difference between these two. Okay, so difference between these two, which is 1.75 is what I was telling you, minus 0.25 commission to the dealer. Net gain is 1.5, which will be shared equally as 0.75 each. Now they've asked what is the net cost to each of them. Now this 75 saving is from where? From their original cost. This is the saving. What was the original cost? BPLR plus 2.5 and 2. That is what we saw, no? Original is 2 and 2.5. So for both of them, 75 bips saving will be there. Okay, so from that you make the saving, you'll get BPLR plus 1.75 and 1.25. Now, how does this work? How does the swap work? I showed you in an example when I was explaining the concept. So that is not asked here. Here they've just simply asked what is the effective rate for each of them post savings. This is what you have to give. You need not say, they have not said what are the cash flows associated with it, what is the interest rate coming in, what is going out, who will pay, how much to whom. That is not asked. So we need not bother about it. Now, this is the question I was telling you, May 19 old, where they asked a question where a swap cannot be arranged. See, why? You let us see. IM is an American firm having its subsidiary in Japan. And J is a Japanese firm having its subsidiary in US. They face the following interest rate. IM floating is this and fixed is this. JI floating is this, fixed is this. IM wishes to borrow at floating rate. IM wishes to borrow at floating. This is what I want to borrow. And JY at fixed rate, which is what I want to do this. So both together is how much? L plus 4.75. The amount required by both parties is same. The current swap rate. Financial institution requires 75 basis as the commission for arranging swap. Companies agree to share the benefit equally. You are required to find out whether a swap can be arranged. Now, cost of what they want is LIBOR plus 475. What is it that they will do if they, instead of that, if they take other loans? If I want fixed, I will take floating. If I want floating, I will take fixed, and we both will swap with each other. What is the cost of this plus this? LIBOR plus 6.5. So cost of loan that you want is L plus 475. Cost of loan after swap is LIBOR plus 6.5. Why will you swap? So no party will swap. So no beneficial swap can be arranged. The swapping cost increases. What is the rate of interest for both? Existing rates are better. This is what is my answer. Institute answer is not this. They randomly did some, mixed masala magic and said that some swap can be arranged. I completely disagree with that. Okay. Now, let us move to the next question. We have finished 21. After 21, 25, 28, 29, 30. 25, 28, 29, 30, and 29, we have already solved it when I was explaining you. This is basically, cheapest to deliver bond and all that. We got 420 and all that. So I will not go through that 29 again. 25, 28, and 30. So first, let us look at 30. Then I'll come to 25 and 28 because 30 is an interesting question. Suppose a dealer bank quotes for a generic swap. Generic swap means normal swap. AIC. All inclusive. AIC means all inclusive cost. 8%, 8.2. That is, if I have to pay fixed, I'll pay 8. If I have to receive fixed, I'll receive 8.2. Versus 6-month LIBOR flat. That is, there's no additional charges in addition to the LIBOR. Notional principal amount of swap is $1 million and the same is for a period of 3 years. Reset after every 6 months. In this context, answer the following queries. Interpret the code. Very good question. What is the code? Interpret the quote. What do you mean? Generic swap means a swap to exchange cash flows of floating rate loan with a fixed rate loan and vice versa. This is what you have to mean. What is the, interpret the dealer bank quote. If a firm is buying a swap, what is the nature of cash flows? Okay, that is the second part. But first thing, what is the quote here? Generic swap here means so and so. AIC means all in cost. That is 8 and 8.2 are full cost. There are no additional fees. Okay. Then 8 is the bid. At this rate, bank will pay. 8.2 is asked. At this rate, bank will receive fixed and pay floating. Then floating rate is 6-month LIBOR. That is also very clear. Flat refers to no additional charges on floating rate. So it is directly LIBOR. It is not LIBOR plus some other spread. Okay. This is the dealer quote interpretation. Then if a firm is buying a swap, what is the nature of cash flow? If I am buying a swap, okay, if I'm buying a swap, it means that the firm will receive floating and pay fixed of 8.2. If you are buying, then the bank is selling. Bank is giving you a quote for interest rate. When a bank is giving you a quote for fixed interest rate, they give buying and selling. Buying is what? At they gave bid and ask. Bid is the rate that they will pay. Ask is the rate that they will receive. So if they have to receive, they will receive 8.2. So here, the firm is buying a swap, it means that the firm will receive floating and pay fixed of 8.2. Firm is selling a swap, it means that firm will firm will pay floating and receive fixed rate of 8. Okay. Then what else? Firm is selling means bank is buying. If bank is buying, it will pay at 8 only. Okay. That is the logic. Then calculate semi-annual fixed payment to the buyer of the swap at end of every 6 months. What is the semi-annual fixed payment for the buyer? So this itself should give you semi-annual fixed payment for the buyer. Buyer payment and for the buyer. Payment means what? I am making payment. If I am making payment means I'll pay 8.2 and I am the buyer. So if I am buyer, answer to question number 2 is 8.2 should be the answer. This should give you the idea for that. Anyway, 8.2. What is it? 8.2 into 180 by 360 into 1 million, which is 41,000. Now here they have not given the exact day count. No, they have said 30 by 360 day count. So you can directly divide by 6 into 6 by 12. Okay. The 6-month period from the effective date of the swap to the settlement date comprises of 181 days, and the corresponding LIBOR was 5% of the effective date of the swap. Then what will be the first floating rate payment for the buyer? See, the year they made a mistake. They should, when you say 30 by 360, you cannot again say 181 days. Okay, but nevertheless, floating rate payment to the payment to be made to the buyer. That is, how much will the buyer is going to give 8.2 to the bank. So how much will bank give the buyer? And bank is giving how much? LIBOR of 5%. So 5 into 181 by 360 into 1 million. This is 25,138. Okay, this is not a net amount. This is the overall amount. Then, if the settlement is on net basis, how much the buyer of the swap is to pay or receive at the end of for 6 months. So this is linked to 0.5. If it is on net settlement, see in the 0.4 we did it 180 by 360 because they said it is 6 months, but here they have given 181 days. So this you cannot directly take this 41,000. You have to again do 1 million into 8.2 into 181 by 360. You'll get 41,227. So you will pay 41, receive 25. So the net amount will be, you will pay 16,088. That is 41 minus 25 is 16,000, which is why I want to do this first before I did the other ones. Okay, now this is 29 and 30 we are done. Then we have to do 25, right? 29 and 30 we have done. 25 and 28. Let us look at this question. Question number 25. A Limited is considering a 50 crore 3 years IRS. Okay, the company is interested in borrowing at floating rate. However, due to its good credit rating, it has competitive advantage over lower rated companies in fixed market. You can borrow at fixed rate of 6.25% or floating rate of MIBOR plus 0.75. These are its rates. Presently, MIBOR is 5.25%. Is expected to change in 6 months. MIBOR may go up, so rates will go up due to political situation in the country. X Limited, an intermediary bank. This is A Limited is one guy. X Limited is an intermediary bank. Agreed to arrange a swap. The bank will offset the swap risk with a counterparty B Limited, a comparatively low grade rated company. So the bank is taking the credit risk. Okay, please remember, which could borrow at a fixed rate of 7.25 and floating rate of MIBOR plus 1.25. So it has higher cost. X Limited, that is the bank, would charge 12 lakh per year as its fees from each party. Mr. Finn, the CFO of A Limited, decided A should receive 60% of arbitrage saving before payment of fees from swap, as A has higher credit rating. So what I gave you example of credit rating means same is directly when the swap happens between two parties, and I would take your loan, you take my loan. But here in this question, they have different credit rating. So the benefit is also shared differently, and the bank will have to somehow convince the other party that even though they have a lower credit rating, try and swap it out. All right. Any fees to the pay to the bank are tax applicable. are tax allowable and the applicable tax rate is 30%. You are required to evaluate whether the proposal is beneficial for both the parties. Assuming MIBOR was to increase to 5.75 immediately after the political crisis is over and shall remain constant for the period of the swap, evaluate the present value of savings from the swap for A Limited, assuming that interest payments are made semi-annually in arrears. Always payments are made in arrears. Now, what is the first question? Evaluate proposal is beneficial for both the parties. Let us see. A Limited fixed is MIBOR plus 75 and floating is 625. B Limited is MIBOR plus 125 and fixed is 725. What does A want? The company interested in borrowing it floating rate. It is getting it lower rate than company. It is getting, because due to its good credit rating, it is getting lower rated in fixed. It wants ideally floating. What is its floating? This I wrote ulta. This is floating. This is fixed. So what is the floating it is getting? It is getting MIBOR plus 75, but it is getting a much better rate in fixed, which is 6.25. Now, so ideally it wants MIBOR plus 75. Okay. So if it takes MIBOR plus 75, the other party will take 7.25. What will be the total thing? M plus 8. If the other way it works out, if it works out the other way, that is, instead of borrowing it at floating, if A Limited borrows at fixed, it will get it at 6.25. And how much will B get? B will get it M plus 125. So if you add these two, how much will you get? M plus 7.5. So instead of borrowing what I want, if I borrow in fixed, instead of floating, if I borrow in fixed A Limited and swap it out, there is an overall savings of 50 basis points. Let us see, is that correct? See, A borrows fixed and B borrows floating. The total cost will be M plus 750, which is 50 lower than A floating and B fixed. They both will swap. Yes. So total basis savings is 50 bips, and on 50 crores, 50 basis points is 25 lakhs. 1% is on 50 crores is 50 lakhs. By 50 crores by 100, that is 0.5. So half percentage is 25 lakhs. A will get 15 lakhs, which is 60% of that. B will get 10 lakhs, which is 40% of that. That is 30 bips and 20 bips respectively. Okay. Now, what is the reduction in interest? I will make 15 lakh saving per annum. B will make 10 lakh saving per annum. And banker's fee, from both of them, you will charge 12 lakhs. For A, net saving is 3 lakhs. For B, net saving is minus 2 lakhs. And tax is the impact of the saving, whatever is the saving that you made, on that there is going to be a tax impact, which is 30%, 90,000. So A will make savings of 2,10,000 and B will make a loss basically of 1,40,000 adjusting for tax. So swap is beneficial only for A, as their net savings post tax is 2 lakh versus net loss of 1,40,000 for B. So this is the answer they will give. So how did we work out on all this? Basically, found out what is the interest saving. That interest saving you found out per annum. That per annum you split between both the parties. From that you subtracted bankers' fees of 12 lakhs. From that you then took the tax advantage and found out the net saving. Okay, post-tax saving. Now, what is the second thing? Assuming MIBOR was increased to 5.75 immediately after the crisis over and shall remain constant period of the swap, evaluate the present value of savings from swap, assuming interest payments are made annually. So here, assume for a moment that the swap is entered into, even though it is not beneficial for B. Assume for a moment that some dealer does some activity whereby they reduce their fee for B or something like that, and B also enters into a swap. Then, what is the original cost of the loan? MIBOR plus 75. Correct? They want ideally this is what they want, no? MIBOR plus 75. Right? From that, they are making savings. From that, they are making savings. Savings of how much? They are making savings of 30 bips. Okay, so it becomes MIBOR plus 45. But please note, this 30 bip saving is before the payment to the dealer. Okay, so their now effective cost is MIBOR plus 45. Now, discount rate. At what rate will you discount these savings? The saving, you will be discounting these savings at a fixed rate. Why is it you will be discounting at a fixed rate? Because you have to present value them. So all these savings of MIBOR of this 30 bips, whatever you're going to save, this 30 bips you will discount it at one fixed rate for the next 3 periods. Now, in a swap, for how many periods do you have? This is a 3-year swap with every 6-month payments. So 6 periods are there, but the first period rate is already fixed. So only for the balance 5 periods you have to see. So discount rate will be what? Discount rate will be 5.75 plus 0.45. Why? Because a cost of borrowing post this savings is 45 bips, right? MIBOR plus 45. So, and MIBOR is static at 5.75. They said no. Assuming MIBOR was to increase to 575 immediately after the political crisis and shall remain constant. So 575 is MIBOR value, 45 is the spread. So you will discount your savings by 5.75 plus 45, which is 6.2% or 3.1% for 3 months. Now, present value interest factor of 3.1% for 5 periods. Please note this is for 5 periods. Why? Because as I explained you, out of 6 periods, for first period is already done. So, present value interest factor of at 3.1% for 5 periods comes to 4.5667. Now, 4.5667 into how much saving do you make? You make saving of 5.25 lakhs. How did we get 5.25 lakhs? 5.25 lakhs is, what is this 5.25 lakhs? 5.25 lakhs is 0.3 into 50 crores. 50 into 0.3 is 30 bips is per annum, correct? So 50 crores, 8 zeros, into 0.3% is per annum. So for half year, it is 7,50,000. But this is pre-tax into 0.7, because post-tax of 30%, you get 5.25. So how did we get this? 30 bip saving. I'll write this here in a page. Savings 30 bips, right, on 50 CR. So 50 CR into 0.3% for 1 year is how much? Is 15 lakhs. Correct. So for half year is 7.5 lakhs. This is pre-tax. And tax at 30% is 30% of 7.5 is 2.25. So 5.25 is post-tax saving per half year. Correct. So that is what is this number. So 5.25 lakhs into present value factor, you get 23.97 lakhs. 23.97 lakhs is for what? Is for entire period of your 5 periods. Whereas how much do you have to make payment? You have to make payment of 12 lakhs per annum. It is 12 lakhs per annum. 12 lakhs per annum. But for the first, the swap is only for 5 periods, not for 6 periods. So 12 lakhs by half is 6. 6 you multiply with the same present value factor of 4.5667. So you will get the amount with respect to your dealer payments or dealer charges is 19 lakhs. So you subtract 23 minus 19, you get 4.79 lakhs. So this is the net value of the benefit that is going to accrue to A Limited. Okay, assuming that they enter into the swap, even though it is not beneficial to B. What if they said evaluate the present value of savings in the swap, assuming interest rate based payment? Okay, did they ask anything else? Let us see the savings. 7,50,000 minus 525. You have this discount factor, like that you do for 5 periods. That's all. There's nothing else. Post-tax interest rate is considered 6.2 into 0.7, then 4.34%. Now, here one of the points that we have taken is cash flows are post-tax. So should the discount rate also should be post-tax, right? So if discount rate of 6.2 is pre-tax, so you should into 0.7 is 4.34. If you take that as 4.34, then instead of doing present value at 3.1%, you may do a present value at 3.1, which is half of 6.2. You may do it at half of 4.34. Then obviously this value of the savings will not be 4.79 lakhs, but it will be 4.92 lakhs. It will slightly increase because the discount rate is lower. Okay, interesting question, right? There are multiple combinations, multiple things that can happen. Okay, we have done 25. Next, we have got to go to 28. This is the last question in this chapter. We have covered everything with respect to interest rate risk management. And I've explained you everything so far with respect to how swaps work, how caps work, how collar works, and how we have seen varieties of questions in this particular chapter. So this is the last question. With this, we will be if you have come till here, I am pretty sure you have understood everything so far. If you have any feedback or if any doubts, please comment on this video, like this video, share this video, subscribe to our channel, inform your friends. Please do all of that. Okay. Now, K Limited currently operates from 4 different buildings and wants to consolidate its operation to one building, which is expected to cost 90 crores. So 90 crores. The board of K approved the above plan, fund the above cost to agreed an external commercial borrowing, that is an ECB. So they said we will incur 90 crores of capex by borrowing by raising an ECB. They call it raising. Okay, ECB, external commercial borrowing of 10 million from G Bank for following conditions. The loan will be availed on 1st April 2019 with interest payable on half-yearly rest every half year. Average maturity will be 3.4. Average maturity means think of average due date concept, what you studied in CA foundation or somewhere, where you even different cash flows have different dates, but on an average, what is the due date if you weight it by money? So average maturity of the loan will be 3.4, but the overall tenure is 5 years. Please don't confuse this with the concept of duration. Duration also has a present value factor. This average maturity is without the present value factor. I've explained this in my full class as far as the interest rate risk management chapter is concerned. I've also explained this in the fixed income chapter. Average maturity is 3.4, overall tenure is 5 years. Upfront fee is 1.2, interest cost is LIBOR, 6-month LIBOR plus 250 bips, and 6-month LIBOR is expected to be 1.05. So currently the LIBOR is 1.05. K also entered into GBP INR hedge at INR is equal to 1 GBP is equal to 90 INR to cover the exposure on account of the loan, and the cost of the hedge is 4%. So the forex hedging cost is 4%, and the upfront fee is 1.2, and floating rate is L plus 2.5, L is 1.05. As finance manager, given the info information, taking 1 GBP is 90 INR. So please note, they want to raise how much? A 10 million loan. 10 million means 1 crore. 1 crore into 90 INR per GBP. So 1 crore into 90 is 90 crores. That is exactly the cost of the building. Calculate the overall cost both in percentage and rupee terms on annual basis. What is the cost of hedging? If K wants to pursue an aggressive approach, what would be the net gain loss for K Limited if the INR depreciates or appreciates by 10% at the end of 5 years, assuming the loan is repaid in GBP at the end of 5 years? So let us see what is this. So first point, calculate the overall cost. What is overall cost? 6-month LIBOR is 1.05. To that, you add 250 basis points, which is the spread which makes it 3.55. Upfront fees. Upfront fees is paid for average maturity. Okay, it is not paid for the full tenure of the loan. So 1.2% divided by 3.4 is 0.35% per annum is the upfront fee that you pay. So upfront fee is paid upfront only. But when you're computing the overall cost of the loan, how will you account for upfront fee? Will you say 1.2% every year? No. You will say 1.2 divided by 3.4. That you will add to the cost of the loan. Right. So 1.05 plus 250 makes it 355, plus 0.35 makes it 390. Then hedging cost is 4, which makes it 790, which is what we got. Okay, this is the first part, overall cost in percentage in rupee terms. Now this is in percentage. What is in rupee terms? Rupee terms, 1 crore GBP into 90 into 7.9, or you can directly take 90 crores into 7.9, which is 7.11 crores per annum. This is the first part. What is the second part? What is the cost of hedging in rupee terms? What is cost of hedging? Directly 4%. 4% is 90 crores into 4% is 3.6 crores. This is per annum. Please note the hedging cost is per annum 4 crores, 3.6 crores. For the entire maturity, it will be slightly different. Why will it be different? How much will it be? See, also please note, when you are saying that the loan average maturity is 3.4 and actual tenure is 5, it means that it is getting repaid in between, which is why the average maturity is falling. If the entire loan is going to be paid only on the last day, then the loan's maturity will be 5. Loans average maturity will be 5. Here, some repayment is happening in between. So, if repayment is happening in between on principal value, the cost of hedging is 3.6 crores for entire 10 million or 90 CR. Per annum, it is 3.6 crores. But after the interest is, after some amount of principal is repaid after year 1 or year 2 or year 3, this hedging cost will come down. Why? Because it is on the only balance amount of loan. No? So, you have to give it as 3.6 only per year. You cannot give it for all 5 years put together. Okay, if you want, you can directly say 3.6 crores into 3.4 years because that is the maturity. You can do that also. But you cannot say for year 1 is this, year 2 is this, year 3 is this, because we don't know what are the repayment terms. So, per annum is 3.6. Total basis is 3.6 into 3.4. But year 1 is how much, year 2 is how much, we don't know. Then, what is the third point? K Limited wants to pursue an aggressive approach. What do you mean by aggressive? You are hedging here. If you are hedging means you are conservative. If you are not hedging, then it is aggressive. So they have left it open. What would be the net gain loss for K if INR depreciates by 10 or appreciates by 10 at the end of 5 years, assuming loan is repaid at the end of 5 years? So this part I don't understand. If the loan is being repaid at the end of 5 years, then this whole 3.4 years average maturity is irrelevant. 3.4 average maturity comes only when there are in-between repayments. Anyway, if you are going aggressive, you're not hedging, and end of 5 years, you repay entire, only at the end of 5 years, you repay the loan. Then what is the benefit or loss? So what they're basically saying is, assuming INR is not hedged, and if rupee depreciates by 10% from 90 to 99, so how much you have to pay? You have to repay 10% of the loan value extra. That is, you have to pay 9 crores extra. Why? Because rupee is depreciated by 10%. So entire 90 to 99 is what it will go up to. So loan is 10 million and 9 crores is what you have to pay extra. But You have saved how much? You have saved cost of hedging of 3.6%. 3.6 crores. Okay. This 3.6 crores into 3.4 years, if you do, that is one way to look at it. Annual cost of hedging, if you take it as 3.6 crores, then that is another way to look at it. Okay. That is first one. Second, INR appreciates by 10%. So if INR appreciates by 10%, there is a benefit. Benefit of how much? 9 crores. But 9 crores, you have also saved 3.6 crores every year by not hedging. So your total saving is 12.6. Now, again, I don't fully agree with this. This is ICA solution. Either you take it as a cost or you take it as, here you're subtracting because you have, that is the incremental cost that you've incurred. If you're treating it as incremental cost, you cannot take it as an again gain. Okay, but ICA solution is like this. They said that 9 crores is what you have saved, and you've also saved extra 3.6 crores, which is 12.6. First of all, this 3.6 is not correct because it is per annum. You should ideally do 3.6 into 3.4. That is one discomfort that I have with the solution. Okay, so now this particular thing concludes the entire chapter of interest rate risk management. We have seen everything in this chapter with respect to what are the factors affecting interest rates, then what are the various kinds of interest rate risk. Then we went on to look at what are the limitations of gap, how do banks manage, what are the measures, then what are benchmark rates. This benchmark rate is an important thing for exam. Then what are the various kinds of risk management tools? In this risk management tools, we've learned about ALM, forward rate, FRA, then FRA, how is it settled, then interest rate futures, then we went about caps, floors, then swaps, interest rate collar, then swaps explanation, then swaption, types of IRS, then OIS, overnight index swap. So we have seen everything that is there in the chapter. You've got full knowledge of this particular chapter. I assume or I believe that you've understood this chapter very well. If you have any doubts, as I said earlier, please comment on this video, please share, please like, subscribe the video, and you can always reach out to me on forums in our app or website. And my sincere request is, along with this video, I am also uploading this particular last day revision notes for this particular chapter. Go through that, and in the description below, I've also given the list of all other revision videos that I have. Okay, you can go through them as well. Okay, so I hope this has been very, very useful for you. I hope that you go and look at my other videos as well and study extremely well. Okay, all the very best for your exams.